markets should take notice. No one's pivoting anytime soon.
When you look at the market reaction today, I think what they're telling us is that string of hawkish central bank meetings is over.
It's not just about the Fed, it's also about what's going on in the rest of the world.
All central banks are going to be in a similar position. Key issue, of course, is the extent to which price pressures are coming off.
It's when the labour market breaks that we've really struggled.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Here are the year-to-date scores. The Nasdaq up 17% year-to-date. The S&P 500 up close to 9 full percentage points year-to-date. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures, Tom, negative this morning by 0.8% off the back of tech earnings after the bounce yesterday. Going into payrolls a little bit later this morning.
Let's link tech earnings into the jobs report coming up as well. I mean, you're looking at layoffs and all that and right-sizing and rationalization. The word I use is I thought it was clumsy, what we saw yesterday, and it was story to story. And the number one story I saw is, can Tim Cook go to Washington and solve everything? I mean, I don't know what else to say. Yeah, Apple's off today, but he isn't laying off anybody. He's sort of the anti-big tech right now, is how I'd put it.
I think you have to compare the moves this morning in the pre-market to the moves at the close yesterday. And if you go through them piece by piece, Apple was up 3.7% yesterday. Meta was up 23%. Amazon was up 7%. Alphabet was also up 7% in yesterday's session. So when you look at the price action this morning, just compare it to what we did yesterday, and we're kind of like this, unchanged.
That's a really good point. Basically, we're retracing some of the optimism that we saw yesterday on the heels of Meta, that perhaps they're going to beat it out of the park. They're still up on the year. They're still doing really well. The key question here is this the beginning? And you talk about layoffs heading into the jobs report. Are the cutbacks that we're seeing enough to bring big tech in size with where the economy is right now? And who is to follow? And I think that really is one of the conclusions I drew from this.
Or the bipolarity here of four companies. We'll talk about this with Ron Temple in a moment. But this alternate universe of 4 or 5 companies, and everyone else, is, Lisa, with your earnings reports you've been doing, are absolutely brilliant, showing the rest of America.
Well, and I will say this, that if you look at the consolidation of profits, Apple consolidated 85% of smartphone profits last quarter. So when you talk about who's winning, this is the issue. Intel's losing, but you see Taiwan Semiconductor Manufacturing Company winning and Samsung winning. So this is winners and losers as well.
And on the unit sales, I don't have the Mark Gurman numbers in front of me, world class at Bloomberg, but John, basically iPhone, OMG, they're down X amount of percent, which was way less than the unit sales decline at Samsung.
That's the hardware unit. The iPhone unit at Apple. Let's talk about the cloud business. The years of acceleration are over.
Surprise,
The guide that we've had from Microsoft, we're looking at deceleration. The guide we're having from other companies now, Amazon, just to name one, it's the same story. We now need to think about deceleration, and that's a shift from the last 5 years.
And it's a shift with respect to hiring as well. When they start talking about how they're going to use artificial intelligence to boost things, they're not talking about the sort of seismic growth and expansion. They're talking about right-sizing the platform that they currently have.
But let's take this away. Let's ignore the earnings just for a moment. This is so painful for so many people. I think it's all well and good sitting here and saying, the weak data is going to come in a couple of quarters. I read that note from Mislav Matejka over at JP Morgan earlier this week, and this is not aimed at him. It's just aimed at the idea that you can be short this market in the face of a rally like this. It's so painful to do that. Tom, what we need to work out, is there a window of opportunity here? How big is that window? Is that window about to slam shut off the back of some really weak economic data or not?
I like what Olivier Blanchard says in his book, where he coins it the Biden stimulus, that last big pandemic oomph. We're getting over it, and it's affecting everyone. Take Amazon as a whole in spades, and the labor model is going to be the outcome for the American people. And, you know, you look at the jobs report we're going to see here at 8:30 in 2 hours or so. And, you know, I guess surveys under 200,000, that's beginning to show that labor range you're talking about.
189. Still pretty decent numbers.
Oh, I'm flabbergasted.
Down from 223.
Claims got buried yesterday. Was claims yesterday?
It was yesterday morning.
Claims got buried yesterday. And look at the 4-week moving average of claims. It's a comedy.
Hey, phenomenal numbers. Futures right now down about 0.8%. Let's whip through the price action together. Equities today a little bit softer, but over the last week, the Nasdaq is on course for a 5th week of gains. Best week since November, up about 5% on the week already, and Tom up 17% year to date. That run is just phenomenal.
So for everybody, and thank you so much for staying with us on radio and TV over 3 exhausting days, really marathon days. How do you link this together, John? And I think the way you link it together is in today's jobs report, if you see some form of quiescent wage growth, that gives a further backstop to Chairman Powell to do what he shocked the world with in that press conference, and that extends out the duration play on tech and the NASDAQ 100 maybe, perhaps continues its lift.
The wages, Lisa, a big focus at about 8:30. I think you did all right. I think you did all right.
Not awake, but fine. Tang Zero hasn't clicked in.
I will say, John, just picking up on what you're talking about, that's exactly what I'm looking for. You talked about the 189,000 number that a lot of people are talking about for the headline for the U.S. January non-farm payrolls report coming out at 8:30 a.m. I'm watching average hourly earnings. How much do they go down to 4.3% year over year versus 4.6%? Is that enough to give the Fed confidence to really downshift in tandem with what the market is currently expecting? 9:30 a.m. Joining you, John Ferro, Labor Secretary Marty Walsh joining Bloomberg Television. I'm curious what he has to say about the push from labor. We see this even at Google, Alphabet, as people start to protest some of the layoffs and cutbacks. Does he support that, especially if that really pushes wages up further at a time when that could potentially create some problems for the Fed? 10 a.m. we get ISM Services index data. Do we get an actual reacceleration into positive territory, expansion territory? And John, we talked about what we saw in the manufacturing and the factory sector, very deep contraction that seems to be deepening. Perhaps not the same story over in services.
Bramo, thank you. Looking ahead to the data a little bit later. Always fantastic. Just always on the game.
Did we get German inflation?
No, not yet.
I looked this morning.
This week. The Guard referenced that. Did you see the compare and contrast between the Guard and Powell? Were you surprised by it?
Well, she didn't wear the scarf for France. She wore the World Cup look the last
time
around.
She said the risks around inflation had become more balanced. This 24 hours after we heard from Chairman Powell saying the disinflationary process had started.
Yeah, my headline is I was significantly exhausted by 3 central bank meetings.
Once you've said that, when you follow it up with the same thing, which is we've got more work to do, no one's listening to that anymore. That's done. I want the new stuff. I'm focused on the new stuff. That's why for a lot of people in the market, Tom, they think these guys are done. One more and see you later. Finished.
Yes, there's no question the market is modeling. Are they modeling in an Hyman disinflation under 3%? Maybe not, but we're way beyond 7% angst.
Ron Temple joins us now, US equity head and co-head of multi-asset at Lazard Asset Management. Ron, can we just start with this rally in tech? Not this morning, which is selling off, of course, but year to date. Ron, just phenomenal. Are you into that rally? Are you fading that rally? How are you even thinking about that rally?
Well, I think investors have gotten ahead of themselves in terms of basically extending that duration, as Tom just mentioned. I mean, this to me is largely about an interest rate call in the tech sector, where people are betting that interest rates are going to be down and stay down. And I think they're extrapolating far too aggressively in terms of that comment about the disinflationary stage having started. Yes, there are signs inflation is decelerating, but this inflation fight is not over yet. And I think investors are overestimating how quickly, or they're expecting the Fed to be cutting rates far too quickly and cutting them from levels that I think are too low. So I think this is a rally you do want to fade. Feels to me like people trying to basically make a play that we're going back to the good old days of zero interest rates and QE, and that is just not happening.
Ron, if it's a short cover in equities, and I would respectfully suggest in bonds as well, and if you got the gamma, the convexity, whatever Greek you want to use here, do you hedge the January lift?
Well, I mean, I guess I look at it, I think there are a range of factors going into it. Tom, I'm not sure I would call it short covering as much as, I guess you could call it short covering in some ways. I don't think it's a short covering rally as much as people were sitting on a lot of cash. If you look at the hedge fund market, basically a lot of the hedge funds were not highly levered coming into the year. And a lot of investors on the institutional side are really, it's a bit of a FOMO, a fear of missing out and a fear of being behind their benchmarks. And so they're feeling forced to get into the rally, feeling forced to extend duration. And so I think that's kind of, it's a pain trade right now. And that's where I think you would want to fade it in terms of trying to position. The hard part is, I don't think it's extended so far that it's an easy call to be saying, let's go short again on this market.
Ron, does the rally that we see now and the optimism around a soft landing ensure a deeper pain or a harder landing later? Well,
that's actually part of my concern is, I mean, if you look at the Bloomberg Financial Conditions Index, financial conditions are easier than they were a year ago. So you've had a Fed that's raised rates 450 basis points, and yet we have an equity market that's basically heading back higher. We've got credit spreads that are tightening, bond yields that are going down. This is effectively a market that, in my view, is almost fighting the Fed. Again, there's a little bit of selective perception here in terms of, you hear Powell say disinflation has begun, but Powell's also telling you rates are going higher than the market's pricing and staying there longer. The market's ignoring the part of the message it doesn't like.
But Ron, aren't we just disagreeing on the forecast? People are allowed to have a different forecast to the Fed, aren't they?
I actually do think in that regard, I mean, with all due respect, I think Powell does a fantastic job, but I think he kind of fumbled the messaging in the FOMC in the press conference by saying, okay, they just have different forecasts. That was pretty counterproductive to what the Fed's trying to accomplish, in my view.
Ron Temple of Lazard Asset Management, you weren't alone with that view. Let's be very clear about that. The penultimate question at that news conference has got so much attention. The comment on financial conditions, the comment on forecasts. Tom, I'm not here to change anybody's mind about their forecasts. I thought that's precisely what they have been doing for the last 9 months, which goes back to that quote. I think the perfect framing from Steve Englander yesterday, Tom. We've gone from conditional hawkishness, non-conditional hawkishness to conditional hawkishness. And that's a change.
Yeah, let's be clear. Dr. Englander is a Yale sophisticate. When you come out of Yale in the world of James Tobin and Robert Shiller and the rest, this idea of unconditional dynamics over to conditional dynamics, it's fraught with a lot of before the fact, after the fact dynamics. Guess what? I think Steve Englander would agree with us. They're still massively ex post, including what we're going to see at 8:30 this morning.
He speaks next week at the Economic Club of Washington.
Steve Englander?
Chairman Powell does. Are you expecting him to walk this back?
That's a really good question. I think he may send out surrogates to walk it back to maintain their ultimate fear, which is to lose credibility.
That's going to be how we kick off the week next week, isn't it? Is Chairman Powell walking this back, or is he repeating the message, which a lot of people received in the news conference this week?
If he walks it back, that's also perilous, to Tom's point, because there's a credibility issue. At the same time, it's clear, you talk about ex post facto, not necessarily. If they're saying that, we're worried about going too far, if the balance of risks have shifted, suddenly this is a very different Federal Reserve.
Equities down 0.9% on the S&P. Coming up in the next hour, Priya Misra of TD. Looking forward to that. TK, freezing cold in New York today.
Yeah, I'll give you that. Finally. It's like late March in Western New York.
Okay.
But,
What's the line in the sand for you? Or the line in the ice, so to speak? What is it? What makes it cold for you?
Line in the sand right now is when you get 6 inches of snow and your dad says shovel the ice rink, and 2 days later you get another 6 inches, and you just don't.
Well, I don't think we're not getting snow, right?
No.
No.
Just getting ice.
No, this is where I'm up towards the Arctic Circle.
We'll talk about the weather balloon next. Down in D.C. with Anne-Marie.
What's
Have you seen that balloon?
Have
you seen that balloon?
Yeah.
Isn't that a crazy story? Weather or China? China, obviously. That's next. This is Bloomberg.
And we're going to hit that story right now, Jonathan. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Well, the Pentagon is tracking a Chinese surveillance balloon that lingered at a high altitude over the western U.S. That balloon was spotted over Montana, home of the ballistic missile silo. Now, Pentagon advised against shooting it down because of the risk of falling debris. All this could complicate Secretary of State Anthony Blinken's visit to Beijing next week. The U.S. labor market probably continued to moderate at the start of the year. Still, wage growth, a historically low jobless rate, and high vacancies are expected to keep the Fed from lowering interest rates for some time. Today's jobs report is likely to show that payrolls rose by 189,000 in January. Shares of Apple are down after the company reported its worst holiday performance in 4 years. Supply chain issues and a softening economy hurt iPhone sales. Revenue fell 5.5% in the December quarter, Apple's biggest sales period of the year. Still, CEO Tim Cook sees signs of rebound in China. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We believe the House cannot pass a debt ceiling bill the way they're talking about it. That If it is very minor cuts, the MAGA Republicans will rebel. If it is major cuts, the more mainstream Republicans will rebel. That's why we're saying, show us your plan, because I don't think they can get one together.
Was Senate Majority Leader Chuck Schumer there? And Bramo looking for a sub 100k payrolls report a little bit later.
Are you serious?
No, but, okay, hold on a second.
No, I'm not. Was that a deep fake?
No, it wasn't a deep fake.
I was
citing that some people were saying, including Morgan Stanley's Seth Carpenter, that in the next few months you could get sub 100,000 possibly.
Maybe.
And that would get a bit of it. I'm not saying that, just to be very clear.
Unless it is sub 100k, in which case, great call, right? That's how these things work.
It was ChatGPT.
Yeah, right. Equity futures right now down 0.9% on the S&P. Earnings not tremendous from some of the big tech players after the close yesterday, but the rally we've seen so far year to date really is the headline. On the Nasdaq, up by 17% year to date on the Nasdaq 100, on the S&P up close to 9%. Futures lower, yields unchanged, 338.85, and Tom, euro dollar 109.28 on euro dollar.
After the marathon 3 days we've had, can we institute surveillance GPT? I mean, it would be...
You want to do AI for surveillance?
Yeah, well, we do it every day anyways. We might as well just codify
deep fake the anchors.
Right.
Michael Hartley of Bank of America this morning, Tommy, said this: most painful trade is always the apocalypse is postponed. He says we say fade the S&P 500 above 4.2k on peak Goldilocks this month.
With immense respect, the writing this weekend is going to be superb. And we got to get to Anne Marie here in my childhood. But, John, the bottom line is you got Dan Ives at 9:30 this morning.
Looking forward to that. And AMH is too, to talk about your childhood.
He's got some ops.
She can't wait if she's still there.
I'm not going to go into the details because we don't have time. But long ago, when I was 7 years old, I stood in the grass with a bunch of fancy guys with spy cameras. And they looked up at the sky, not at Sputnik, but a thing called Echo. Echo was a big white balloon, it felt like, going through the sky that revolutionized how we communicate. It was trying to bounce radio waves, information from the ground at Vandenberg and other places up to Echo and down again. Anne-Marie Horton here, our Bloomberg Washington space correspondent on the modern Echo, which is a Chinese over. What are they over? What are they taking shots of, Anne-Marie?
Well, at this precise moment, we don't exactly know, and the administration's not telling us the location of the surveillance balloon, but this surveillance balloon was spotted over Montana, and the concern is, of course, that's where we have intercontinental ballistic missile silos. So this is a concern for the administration, given the fact that why are, the big question, the Chinese sending this surveillance balloon over the United States? Particularly the timing of this is questionable, given the fact that Secretary Blinken is headed to China next week. But also, China already has low-level satellites that can also have the capability of doing the same exact thing as this surveillance balloon. So why did they send this surveillance balloon? Because obviously this is getting a lot more attention.
I know your phone is rung off the hook on this, and this, folks, really truly goes back to Sputnik in 1957. A question from 1957, can we shoot it down?
Well, at the moment, what the U.S. has said and what Secretary of Defense Lloyd Austin, what he'd said to the president was we should not be shooting it down because potentially there'd be a lot of damage from the debris that would come down from it. And they don't think that the capability of this surveillance balloon is such that it's worthy to have that potential debris. So they probably have the capability to shoot it down, but they have decided not to.
I think the key part of this story, Tom, is it's not the first time they've spotted this. They're well aware. They're well aware that this has been going on. And with that in mind, Anne-Marie, the talks will continue because the talks never really stopped between the two sides, even when they knew this was going on.
Right. And also, obviously, for decades, the Chinese have also been talking about the fact that the U.S. has sent spy planes and ships as well spying on them. So this has been a fraught issue, a moment of tension between these two sides, as you say, Jonathan. But I think a big question this morning is people are actually asking, will Secretary Blinken go on this trip next week to China, given the fact that this administration is getting a ton of pushback from the Republican Party and using this instance with the surveillance balloon as a reason to potentially maybe Secretary Blinken needs to rethink. But this trip was supposed to be important. This was, the next stage of setting that floor under the relationship of the world's two biggest economies.
Well, tell me about the latest reporting. Where are we with that meeting? Is it still going ahead? Have they responded to questions about that in the last 24 hours?
Yeah, at the moment, nothing has changed publicly, but these are conversations that I imagine are happening behind closed doors. The Wall Street Journal is reporting that the State Department called in the representative from the Chinese embassy, because there's no new Chinese ambassador, but Charge d'Affaires was called in. So this is going to be top of mind for everyone in Washington, D.C. today, especially when you have the likes of Rep. Gallagher, who is responsible for this new China committee that is looking at the threats from China, saying that nothing has changed with the Chinese Communist Party, even though there are potentially these warmer talks.
It's ironic that even as earnings come out for some of the U.S. companies that are the largest and most profitable, I'm thinking of Apple, and they point to China and the recovery there as a point of optimism in their earnings, that the U.S. sees tensions increasing with China. How is Washington reflecting this growing divide between what we're seeing in D.C., the Beltway, and Wall Street?
It's really difficult, Lisa, right? Because the business community is entrenched in doing business in China and making sure that they're part of China's reopening, the growth story in China. But at the same time, the administration is trying to put guardrails on all parts and all avenues of this relationship between the United States and China, whether or not it's business, whether or not it's national security. I mean, at the same time, you're talking about Apple looking at what's going on in China. You have this morning news out that the Philippines and the U.S. also are going to start once again joint drills on the South China Sea. So it's a difficult moment to balance.
Emery, help me
Tom
here.
doesn't agree.
It's no, it's not that I disagree. I mean, this is a serious matter. I get that. I mean, to be blunt, I grew up with it. Emery, to be as direct as I can, it's a balloon. It's not going to turn right over Montana and spy on the Eagles training camp for the Super Bowl for the Kansas City Chiefs. It's a balloon. So it floats over Ferro's apartment in New York in a couple days. It goes over the Atlantic Ocean. Where's it end up? Portugal?
I don't know. I'm not a surveillance balloon expert, and quite frankly, I didn't grow up with them the same way you might have grown up with them. I mean, they are still used, for the most part. A lot of countries, when they want to conduct surveillance over other countries, they use drones or they use low-level satellites.
Is that why Arsenal beats the Tots all the time?
With drones.
With drones?
They use drones for training now. Do you know that?
I did not know that.
They do.
I saw it on Ted Lasso.
Just to look at the pitch movement and make sure people are in the right places. Arteta's doing that at Arsenal. AMH, thank you.
AMH killed it.
Just fantastic. Anne-Marie, thank you very much. Look, this is a tough situation.
It's serious. Yeah.
AMH has touched on it, and we talked about it yesterday. Tim Cook is fantastic at navigating both sides of this, the China side and the US side, and seemingly doesn't ever seem to get caught in between. I find that remarkable, Tom, how he's pulled that off.
Ask Dan Ives about this, and my answer to the iPhone supply constraints and the fancy phone is doing it well is both American citizens and Chinese citizens want the product. That's the common feature.
So I've done some research, and The Guardian has an explanation about why balloons can sometimes be used. Be used instead of satellites, and they're much cheaper to launch, and they can target from a much more comprehensive amount of land with a longer duration from closer down. So that's the reason why people are actually returning to the old once again.
Thanks for that. Thank you. You seemed eager to fit that in. We appreciate it.
I actually think that's interesting, because why would you go to a balloon if you have satellites, right? Like, it's so low tech that people are laughing.
You ready?
I mean, it's like sticking a little helium.
We had a mock-up of Echo 1 in the basement. We had a mock-up, a small white thing.
In the basement?
That he used for telemetry, yes.
Did you, ride it around the basement?
No. But we had a mock-up of Echo 1 in the basement.
That's serious stuff.
We had a V1 rocket engine, too.
Very cool. Equity futures right now, negative 0.8% on the S&P 500. Good morning to you. On the NASDAQ on this payrolls Friday, we're lower by 1.4%. Lisa will run you through the tech earnings a little bit later, but not what maybe some of you expected on the bullish side. But wow, have you had a rally already this year, Tom? Just a move of 17% on the NASDAQ, just a casual move higher of, 8-9% on the S&P 500 year to date.
It continues. In the sell side, Jim Suva over at Citigroup, you're going to have Dan Ives on later. The sell side is massaging the duration of this carnage. And you mentioned this earlier. all of a sudden there is a cloud mystery. Anurag Rana's territory. There's this new mystery about the cloud. But other than that, it's sort of pandemic-y, COVID-y. When they get out of that, then what?
There was a massive expansion in the pandemic, as you know. Apple hasn't had the cuts because Apple didn't have the massive expansion. The cuts have been elsewhere. We've seen it with Meta, and that's why we're seeing a turnaround
Amazon.
now, the year of efficiency from Facebook. I want to touch on the bond market briefly. 2s, 10s and 30s look like this on a 2-year right now. Yield to lower by a basis point, 4.0894% on a 10-year. Unchanged, 338.85 on a 10-year. And finish on foreign exchange, euro-dollar. Chairman Powell sounding a whole lot like President Lagarde. We've got more work to do. It's premature to stop. We know it's not over. What did Governor Bailey say yesterday? Too early to declare victory.
It's very Churchillian.
And then at the same time, when you say things like the disinflationary process has started, okay, that's new. I'm listening. Tell me more. And then President Lagarde says the balance of risks around inflation have become more
I'm going to
balanced.
cut him some major slack.
Tell me more.
I'm going to cut him.
You always do.
These guys are institutions. Their number one thing is, as Lisa mentioned earlier, is credibility, and I'm going to cut him some major slack. They're in tough positions given the deck of cards. Abramowicz has got the Bramocam. Fire up the Bramocam.
Look, we all knew this was going to happen. We'd get to peak inflation and perhaps past that, and that seems to be certainly the case, or it appears to be the case, I should say, in the United States. Now the question is the market ahead of the Fed? Is the market perhaps racing to the horsing? What's the expression?
Oh, no, please, carry on.
Please help me. No, but in seriousness, like whether they're getting ahead of themselves in terms of how far inflation will go down. Will this market get a reality shock if inflation doesn't go down from 3% to anything lower?
Look, from my perspective, it's not about cutting them some slack or having a go at them. I'm just focused on the new information. I don't care about the old stuff on repeat. I care about the new stuff, and we got some new stuff from them in the last couple of days. They've clearly shifted a little bit. Now it's over to your own personal forecasts. Where do you see the data going? That's up to you. And Chairman Powell, I think, finally just saying, you know what? I don't care about your forecast. Have your own forecast. You can have a disagreement with the Fed. What's wrong with that? You can have a disagreement with the Fed on their forecast. You can have your own. We'll find out. What's interesting for me right now is that you can believe in the soft landing story, buy equities, buy risk, all of that good stuff, great. You can believe in the hard landing story, but also be thinking about doing the same thing. Because you've got to work out, if you believe in the hard landing story, when does the bad data really start to hit? And if you're pushing that out, is there a window to keep buying risk? And that is ultimately Binky Charter's point over at Deutsche Bank. We're pushing the recession call out, for him at least, not my view. And if he thinks you're going to push it out, he thinks this rally can continue.
Interestingly, Michael Hartnett, who also came out with apocalyptic discussions about pushing it out in the pain trade, also sees stocks going a bit higher from here, that the momentum is carrying it a bit higher. So there does seem to be a feeling. The problem is, does this extend the downturn on the other side? And that seems to be something a lot of people are discussing.
You know how this works, though. You get the short covering, you get the fear of missing out. Then the narrative starts to build off the back of the price action. Like the story completely changes, then more people get in. We're at that kind of point, right?
It kind of feels
that point
that
where
way.
if you haven't been in this rally, you're like, oh, I really need to get in this rally. So that career risk starts to kick in. You missed it.
The most important thing Ron Temple said is they're chasing benchmarks. It's early February, and we're chasing benchmarks. Should we continue forward?
Please do.
It's Jobs Day, 8:30. Michael McKee fired up to give you the data, and he's told me what matters is the wage dynamic, and it's going to be interesting. John, I know you want to talk here about what we're going to see.
I want to talk about
up.
what we're expecting, Tom. 189,000. Big banks out with their estimates. Citi top of the pile. Look at this for a number, Tom. 305,000.
Whoa, did not know that.
From Citi. Then you've got Morgan Stanley, JP, Evercore, all looking for something around 175K.
Yeah.
But Citi pretty punchy out there with 305K this morning.
We get briefed by someone with one of our great insights of 2022. Sarah House, a senior economist at Wells Fargo. We'll talk about the last mile in a moment. Sarah, I've got to go to the jobs report today and see a survey of average hourly earnings coming in. What are the ramifications to you and Wells Fargo if we get a more quiescent inflation growth of average hourly earnings?
So I think if we get a softer average hourly earnings print, that's really going to increase these soft landing prospects that we've already seen, I think, pick up a little bit here recently, given that the Fed is still hyper-focused on inflation, but particularly that inflationary element coming from the labor market. If we see further softening there,
Sarah, if we see that, should I buy Google?
I'll leave that up to our equity analysts in terms of what
Continue on wage disinflation. What is your call?
So I think we'll see some moderation further ahead as we get further past the extremes of the reopening, the job reshuffling that we've seen, but I still think it remains to be seen how quickly, if at all, we get back to levels that I think the Fed will deem consistent with their 2% inflation goal. So ultimately, we're still looking at an incredibly tight labor market. So we see it with the unemployment rate, we see it with the still very low level of jobless claims, and so it goes back to that idea of, we've made a lot of progress here, but getting that last little bit of inflation wrung out is going to be the hardest and likely the most painful part of the labor market process and correction, which could ultimately lead to job losses.
John did a great job outlining how there was new information at the Fed and the ECB meetings this week, that they seemed to shift their tone to perhaps seeing that the risks were more balanced, doing too much or doing too little. Have you shifted your view of the response function of central banks, that we are now fully past the peak tightening phase and heading into a rapidly approaching easing cycle?
I think we have seen the Fed get more constructive on the outlook. So we saw that with the multiple mentions of the disinflationary process starting and that acknowledgement there. I think they're still very guarded, just given, one, the fact that inflation still remains too high, and that they have been fooled once by how quickly inflation would come down. So I think we're seeing the Fed trying to keep its optionality open. But I think all else equal, we have seen a tilt towards maybe a little bit less tightening and again, maybe slightly higher prospects of pulling off that soft landing.
What kind of numbers, particularly when it comes to employment, would shock this market, would shock you in terms of your understanding of how quickly things were disinflating?
Well, we've seen the jobs numbers come down pretty gradually here over the back half of the year. Now, we're going to get some of the benchmark revisions, some new seasonals, so that might alter the most recent path and momentum. But in terms of what I think would really have to get the Fed's attention and maybe make them start to sweat a little bit, it's probably somewhere below 100,000. So if you look at just the supply dynamics, we really probably even need less than that to just keep the unemployment rate constant. So there is altitude to lose before I think the Fed gets really worried about the state of the jobs market.
How do you explain claims? I think I can speak, Sarah House, for Mr. McKee and say we've never seen it. How do you explain, for example, Drew Mattis at MetLife finds weekly data like claims to be important? Okay, great. How do you explain something I've never seen?
So I think it does speak to the fact that ultimately we are in still a very tight supply spot, and so businesses are very cautious to lay off workers on net. So sure, we've seen a lot of big household names announce layoffs, but overall we're still looking at a very low level of layoffs. So if you look at the JOLTS data, that also shows that layoffs remain historically low. And with the claims number, some of that might be a little bit influenced by some of the difficult seasonals we have this time of year, the fact that maybe some recently laid off employees might not be filing because they would forego their severance. But I think overall, even if you look through that volatility, they're still pointing to what is still a very strong jobs market.
Last year, Sarah, people were talking about the improbability of a soft landing and how basically this was threading a needle that was virtually impossible for the Federal Reserve, that had never been done before. Now we're looking at a probable soft landing that's getting priced into the market. What's your probability and how has it shifted of a soft landing?
Yeah, so we still think that a recession is more likely than not here. So we're expecting that we'll probably see some of that broader widespread weakness in the back half of the year, although we could be looking at a negative GDP print here in the first quarter. But I think so much of this comes down to the fact that we're still that there's still issues on the supply front when it comes to labor, and that's going to be a huge key to this soft landing prospect, where not only are you getting the goods disinflation, the housing disinflation, but whether we get those wage pressures coming down in the benign way where you have employers able to fill positions but not have the cost pressure of it so great, and then you have consumers getting a paycheck and going out and spending and propping up demand for other businesses.
Hey, Sarah, this was great. As it always is, Sarah House there of Wells Fargo, calling that term at the back end of last year, the final mile of the inflation push, and how much harder that might be, Tom, once you get down to something like 4.
Yeah, she codified that. I mean, there's some real, we have pre-Misra coming up on the curve inversion as well. You've got eyes and the tech optimism coming out of the where they were. But, you know, it goes to cable TV and getting in that last mile, that move. And I don't know what those numbers are. Is it 4.9%? Is that different than 5.1%? I don't think so. I'm guessing 3.9 is way different than 4.1.
The number you mentioned,
top line,
183,000 on jobless claims.
I don't,
That is just stunning, Tom.
Yeah.
Stunning. That pushes back against the gloom in a major way.
This is important, and this is from one of our best people, Michael McDonough, I should say, of Bloomberg.
I thought you were going to say Michael Bloomberg. Also one of our best people, Tom.
Mike called me yesterday on Groundhog Day. Thanks, Mike. It was good to hear from you on Groundhog Day.
Really?
Adams didn't get bit. But what I would say here is McDonough's got a very important insight. The people he knows in tech are getting long severances. They're applying for unemployment. They're getting immediate contract work, maybe not at the salary and package.
Yep.
They're not playing foosball. I get that. But, they're getting there. And McDonough says, look, this is not Walmart. This is not, layoffs at Walmart.
I think to McKee's point, and Mike's made this point a few times, Tom, that ultimately we've got to wait to see if this shows up in claims or whether people just transition from one firm, Lisa, and just walk into a job somewhere else.
And what you're seeing in other industries, in the restaurant industries, and the service industries more broadly, is that a lot of companies are not laying off workers because they are concerned about getting them back when times revive, just like their experience when they got burned during the pandemic. So a lot of companies would rather see margin compression now and keep their workforces bigger than they otherwise would.
Can I talk the unspeakable?
Please do.
Some guy's popping 722 at Google. He's going to go, oh, the world's changed. He's going to turn down 487 at some other firm.
I guess someone popping that kind of money at Google.
Yeah.
You talk about
no, there's a lot of there's a lot of people. No, there's a lot of people getting laid off at those.
I'll finish with this.
Income points.
There was a phrase, and I wish I remember who authored this phrase, but it's a fantastic one.
Of the night.
You can't fire what you couldn't hire, and I think that is really true of the pandemic and the years since. Ellen Zentner of Morgan Stanley, 7:30 Eastern Time, about 50 minutes away.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Today's U.S. jobs report may show payrolls rose last month by the smallest amount in more than 2 years. Estimates say the economy added 189,000 jobs in January. Still, wages are expected to keep rising, and the jobless rate is near a 5-decade low. All that's likely to stiffen the Fed's resolve to keep rates elevated for some time. The jobs report comes out at 8:30 a.m. New York time. The incoming president of the Czech Republic says there should be no limits on military aid to Ukraine, except when it comes to nuclear weapons. Petr Pavel spoke to Bloomberg TV.
Ukraine can defeat Russia on Ukrainian soil. It means to push Russian forces out of Ukraine and restore territorial integrity and full sovereignty of Ukraine. I believe that with our support, this goal is achievable, and we should strive to achieve that goal because it's a matter of principle.
Pavel is a retired NATO general who takes office in March. Next week, for the first time in 3 years, the border between Hong Kong and mainland China will completely reopen. That's designed to revive the city's role as the business gateway into the country. Daily quotas and COVID testing requirements will be dropped. Hong Kong will also allow unvaccinated travelers to enter the city. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
We are the new NASDAQ. The way the NASDAQ performed in the 80s and 90s, that's where we went for innovation. Okay, look through that now. You will not find the kind of disruptive innovation. It certainly doesn't dominate those indexes.
Kathy Wood's the new NASDAQ.
Yeah.
That was the ARK Investment Management founder and CEO.
TK's
ready to go. TK's the new Dow.
Yeah, I think that
TK's the new Dow.
I got my Tang down here, but I need the surveillance
for a long time.
Right now.
Well, I will say she also is saying the Fed should drop rates so that they can encourage innovation.
Oh, of course, yeah.
And the interesting thing is I was speaking with a venture capital head, and he was basically saying he thinks higher rates will actually increase innovation because money will go to the founders that actually are able.
Because only the good ideas in history came around when we had
low interest
rates at 0%
obviously.
And QE, clearly. Nothing to do with the valuation of the stocks that might be in the new NASDAQ. No.
Nothing.
Not at all. TK, you ready to weigh in, or you want to avoid?
I really want to avoid talking
Move
about
on.
Cathie Wood. I just, I got a nice Friday karma going here, and, it's good.
You trying to do yoga?
Cool. Nice.
Yeah, let's move on. Alec Webb. Oh, you're going to do a Tech Giants thing. I'm sorry, John. I was stepping on you there.
No, don't worry about it. What are we talking about?
A woman stopped me in the street last night.
What'd
She
she
said,
say?
"Do you and Pharaoh ever really talk when you're not on camera?"
We're asked about that all the time.
Yeah.
Even when we're together, people come up and ask the same question.
So ridiculous.
And TK says, don't tell anyone. Don't tell anyone.
If you want, I can look.
Tech giants Apple, Amazon, Alphabet posting some disappointing results after the close, showing sales softening, consumer demand a little weaker, and expected online advertising growth not coming in the way some of you anticipated. Equity futures off the back of some of that, Tom, down. And looking at these individual names, Apple off by 2.7%, Alphabet off by 4.5%, Amazon off by 5%. I've got to do this again, haven't I? Give me a second. Take me 2 seconds. I'll pull it up on a Bloomberg. You've got to look at where we were yesterday at the close, just looking at some of these names. I could bring up Apple, up 3.7%. Amazon was up 7%. Alphabet was up 7% at the close yesterday, Tom. So you have to compare and contrast where we finished yesterday with where we are right now. And some of those names are still up.
Yeah,
heaven
forbid you'd put it in perspective. I thought Zero Hedge, frankly, did a good. They ended their tech analysis of Apple and using a lot of Mark Gurman's great work with the volatility you mentioned.
Sure.
And they went, it's back to ... where it was yesterday. Which I thought was great. We're going to get perspective on this away from the financials, and I take real issue with the coverage. I thought the foreign exchange delta was huge, for example, at Apple, and painted a more constructive picture. Dan Ives will be with John Ferro in the 9 o'clock hour on that. Right now, we do better with Alex Webb of Bloomberg Quick Take joining us here as well. Alex, with all the hype and the product stuff and all that, frame the level of crisis you see among the big four. We're going to go free cash flow in a moment, but what's the Webb crisis meter look like right now on big tech?
It seems like there's basically a return to the mean. We had sort of rewind a few months. We saw Facebook trading at, less than 10 times forward earnings. We had Apple in the high 20s, Google in the sort of high teens. They were all sort of tightening a little bit, coming towards each other. And some of these companies, clearly over the past decade or so, didn't really need to worry about how much money they were spending. They were growing, gangbuster growth. Now, a little bit more focus on that. Mark Zuckerberg almost said it explicitly. He said we didn't really need to worry. Quite these many words, but he said we didn't need to worry about how much money we're spending. Now we do. That's the sort of difference as well we saw with the earnings yesterday compared to Meta a few days ago, that it was pretty explicit about needing to change the culture, needing to actually focus on how much money it's spending. It said its total expenses be $5 billion a year less.
Right.
We didn't see that quite sort of rhetoric come out of these other companies.
Alex, John emailed me at 2 a.m. this morning. He said, Tom, do a stock free cash flow study. Let's do it right now. I went out 1 year forward on the Bloomberg Intelligence modeling of the four great companies. Good morning, Scott Galloway, who I'm stealing this from. On the big four, they have a summed free cash flow of $250 billion. They add them all up, it's $255 billion. Apple leading the way. What's stunning is the next four stocks, Warren Buffett, Exxon, and two other tech companies, is 57 billion. $57 billion. The drop off here, the uniqueness, Alex, of these companies, I don't think is understood. $250 billion versus 57 billion, which frankly is mostly Exxon. They really stand alone, don't they?
And frankly, when we talk about Facebook, and there was a lot of conversation, as I just said, about the way they're changing the culture, sometimes easy to forget. They also announced another $40 billion of buybacks. So, they have the ability to drop huge amounts of capital on the problems they have, whether it be the stock, whether it be technology. The one thing that is a far greater challenge is, of course, M&A, right? Microsoft's trying some things. We don't know for sure whether they're going to be able to do this Activision Blizzard deal. Apple tends to steer away from those massive transformational acquisitions. They have a huge amount of capital. How you allocate it, now they're having to think a little bit more creatively about how to do so, given the headwinds they're facing.
There's been a lot of hate toward Elon Musk over at Twitter and what he's done with the firings and some of the disruption there. But how much under the hood in some of these earnings reports from the likes, even of Alphabet, is there a bit of a nod to what he did, saying perhaps we can strip back a lot of the people that we have and implement artificial intelligence around the edges to do it more efficiently? We heard the same kind of tone from Meta.
I mean, look, there was massive hiring. The numbers that are most telling is when you look at the evolution of revenue per employee. And if you look particularly at Amazon and Facebook, you saw actually that revenue per employee shrank, i.e. they were hiring people more quickly than they were able to grow revenue. So despite the pretty stellar numbers that some of them were able to post in relative terms during the lockdowns, actually they appear to overhire. Now, that is less the case at, say, Apple or Microsoft than it is at Amazon and Facebook. Now, Twitter is a company that, sometimes it's easy to forget. It isn't a big company in the grand scheme of things. Huge impact, huge, effect on democracy, amongst other things. But, I often think in UK terms, its revenue is less than BT, British Telecom's profit. So that also means it has far fewer employees. The impact of cuts at Twitter are far greater than the impact of cuts at these other companies. I mean, it's tough, obviously, for the people on the other end of that, but the cuts that are being made by these companies is quite small in comparison to what's happening at Twitter.
Alex, you said something that I want to pick up on, that they're not growing at the same pace where they can just keep hiring in this dramatic fashion. What does it say about where the valuations are if we're not in an era of free money anymore? I mean, yes, there's still behemoths and cash cows, but are their valuations justified if that growth, if cloud computing isn't accelerating to the same degree, if the potential perhaps looks a bit different?
Yeah, and that's why you have to differentiate a little bit between all these companies, because Facebook is trading still at a discount to the S&P 500, Google's about there or thereabouts, Apple at a slight premium. Amazon historically has traded at quite a large premium, but that is because the expectation always was that all they could, if they twist the spigot a little bit, they could actually move into a far more profitable space. What we saw during the lockdowns is they massively expanded capacity in warehousing, in headcount, all these other things, but all of a sudden it actually became a little bit harder just to, reduce your spend and move towards profit. With the cloud slowing down, it is still growing. It is still, faster than any of these other businesses. The pace of that growth is tempering. One interesting wrinkle in all of this is some of the chip companies, AMD, they reported recently, they make the chips for these servers. The numbers weren't actually all that disappointing. There's a suspicion that companies are actually doing more on-prem. They're actually building their own servers, not barreling as fast into the cloud as they were, because their processes they kind of want to keep to themselves. It'll be interesting to see if that story actually holds true, if that bears out over the years ahead. But there is a little bit of a wrinkle amidst all of that.
Interesting. Alex, thanks for that. As always, Alex Webb there of Bloomberg over in London. Equities are softer off the back of some of these stories. We're down 0.7% on the S&P. The Nasdaq down by a little bit more. We are about an hour and 35 minutes away from payrolls in the United States of America. We're looking for something in and around 200k, maybe close to 190,000, Tom. The estimates are in. That number might change a little bit going into the print. You want the whisper number? Mike McKee's going to bring us the whisper number later.
How do you feel about whispering on air?
Whisper it. I don't know. The president's kind of into it.
Yeah, I know you are.
But he uses it to make a point.
So is Tom.
You do one
Tom
over.
does that too.
You do 1 over the square root of whatever, except with payrolls, the square root is 150 million. Plus or minus. It's a ginormous number. And what that means is the standard error around the guesstimate of what, John, 189,000 seriously, is like,
well, I'm pleased you've called it a guesstimate.
It's a guesstimate.
It's really educated people.
I get all these emails.
Throwing darts.
Guess. Yeah, no, I get all these emails like the polling, guess it. It's a joke.
You don't provide any guesses in those polls? Wait until you get the UMitch phone call and you're asked about where you think inflation's going.
I'm still waiting. I'm waiting by the phone.
I want Michael from UMitch.
Maybe they're listening.
I want Michael.
Ellen Zentner has a tough job. She's got to actually guess this stuff.
I want Michael. Inflation's going to 5. Did they even ask you, why do you think? They just want a number?
They just want a number.
Do they give you a range?
So actually, that's a really good question.
Or can you just throw out like 20? 25.
And they hang up.
Markets should take notice. No one's pivoting anytime soon.
When you look at the market reaction today, I think what they're telling us is that string of hawkish central bank meetings is over.
It's not just about the Fed, it's also about what's going on in the rest of the world.
All central banks are going to be in a similar position. Key issue, of course, is the extent to which price pressures are coming off.
It's when the labour market breaks that we've really struggled.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
90 minutes away from the payrolls report in the United States of America, live from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance with Tom Keene, Lisa Abramowicz and Jonathan Ferro. Futures down about 0.7%. That's not the story of the year so far. Story of the year so far, a monster rally to start 2023. TK, going into payrolls, we're looking for 189,000.
Measured by the VIX, 23 to 18.44. But what's in the research and what I'm going to look for in the reading this weekend is, do we have a change in volatility where maybe we're getting clarity out of three central banks? I think it's important, John, to not just look at the Fed, where they're saying, okay, disinflation is in trend in some way, and does that lead to a new lower volatility regime? That's sort of the mathiness of where we are right now.
Well, clearly there's a challenge for these central banks. How do you respond to favourable data without easing financial conditions even further? And that's been a challenge for the central bankers so far this week. When Chairman Powell talks about the disinflationary trend beginning, and President Lagarde says the risks around the inflation story have become more balanced, clearly that is new information the market's going to pick up on.
Well, the question is, do they care? Do they care that the market is rising? Do they care that financial conditions are easing? It seems like he didn't care enough to really push back, which either means that they don't think that's that significant, or they think that it won't make a big, that won't make that big of a difference, or they were sort of unintending this to be the case and messed up.
They reaffirm data dependency, and even more than the ECB. Maybe the Bank of England's in that group as well, but I'm sorry, Jen, it's about the data this morning here in, what is it, an hour and 90 minutes. We're going to see that, and also on to Valentine's Day in that key CPI report.
Before we get there, Tuesday, February 7th, in Washington, the Economic Club of Washington with David Rubenstein, Fed Chair Jay Powell. That's the opportunity. If you really cared about how we responded to this, that's the opportunity. That's the stage right there to say something, Lisa.
What he could potentially say is that the market isn't factoring in the pain that they think is required along the way to get down to inflation, right? That perhaps the market is not paying attention to the deceleration in growth, right? So there's a push-pull here. He said both that the disinflation is happening and that growth estimates were going up. He signaled that. That's really the green light for the market.
Quote of the week, Dom Constant, Mizuho. Even if it's a hard landing, it'll look like a soft landing first. Just by definition, it'll look soft before it's hard.
He's super restrictive. That's his
really
phrase.
Interesting conversation earlier this week.
He's saying, look, we're there. We're in this disinflationary trend. He's not alone on that.
Equities right now down 6 or 7/10% on the S&P, just to give you a feel of this market cross asset going into payrolls in about 90 minutes time. Tom, yields come in almost a basis point at 10-year, 338.49.
Yeah, I would suggest you on equities, bonds, currencies, commodities. I've got a more accommodative Bloomberg Financial Conditions Index. I mentioned the VIX under 19 nicely. But, John, what I'm going to say is this screen is going to light up maybe on payrolls, much more on wage dynamics. Average hourly earnings is what I'm watching.
A ton of data today. Let's get some of that for you. Here's Lisa.
Well, I'm really focusing on the same thing that Tom is. 8:30 a.m. we get the U.S. January non-farm payrolls report. Is it north of 300? Is it south of 100,000? Really, the question is going to be whether we see the wage gains really decelerate to the degree that people are expecting. If not, does that potentially make the market rethink some of this shift in Fed speak and ECB speak? At 9:30 a.m., we get the view from this current U.S. administration. Labor Secretary Marty Walsh joining Bloomberg Television with one Jonathan Ferro. Curious to see the view on labor amid a wage increase that people are trying to fight, right? How does he talk about some of the wage disruptions, the labor disruptions that you're seeing, even overseas, and how that applies to the labor force in the United States? And at 10 a.m., we do get ISM services data. And to me, I'm actually watching this possibly more closely than anything else because there is the potential for a real acceleration of services. We saw an ongoing contraction in the manufacturing sector. John, it potentially could go in the other direction for services, which really speaks to this bifurcation in the economy. On one hand, contraction in specific sectors. On the other hand, incredible resilience that continues pushing inflation perhaps higher than the Fed would like to see it.
That's the right word, Lisa. Thank you. Resilience, particularly in the labour market over the last few months. A lot of people anticipating that weakness, Tom. It just hasn't come around in the labour market, in jobless claims.
No, it's
in
been
payrolls.
A complete failure, and a major shout out to Neil Dutta, who I believe joins us later. And I also know James Glassman was on fire yesterday with J.P. Morgan. He says, yeah, people are talking small business angst. He said the reality is they're looking for the next employee.
Neil Dutta, Renaissance Macro, 8:15 Eastern Time, so about an hour and 10 minutes from now. Right now, Priya Misra, Global Head of Race Strategy at TD Securities. Priya, you had 3 calls, and thanks for being with us. And those 3 calls went as follows. It was rates through 5%, yield curve inverted all year, and recession in the back half of the year. Are those 3 calls still the 3 calls?
We still have that call, yes. I think the Fed is telling, I think the reaction function of the Fed has actually changed a little bit. Their urgency to hike, their urgency to take rates more restrictive, I think that's a lot less. They are more convinced of a soft landing. We're actually not. The data is strong. The labor market data is always lagged. I think it's going to be more lagged right now. The service sector is slowing, but in our view is going to slow a lot more in the second half of the year. So, we're still looking for a recession. I think the Fed right now is saying we don't know. We don't know if this immaculate disinflation, which is what we're calling it, will continue. There has been some disinflation clearly. In our view, for inflation to get to 2%, you're going to need that pain in the labor market. And I think that's what the Fed is saying. We don't know. They're going to hike 25. We think they're going to literally live meeting by meeting. We're looking for another 25 in March, then another one in May. I would say there's risk of another one in June. If inflation doesn't continue to decline at the same pace, there's risk of them going up to 5.25 and then staying there all year, because they really need that inflation to get back to 2%. They really, don't want to let inflation expectations get unanchored, and the economy is going to slow down. So, we're looking for that recession still, but I have to say the case of a soft landing is higher today, and I think the Fed is sort of banking on that.
Priya, on the vanilla 2-10 spread, the difference in yield between the 2-year and the 10-year, the 10-year is the benchmark. It's what the media watches. What is your 2-year study? What will be the dynamic of the important 2-year yield?
I think the 2-year is largely about that terminal rate and then what happens afterwards. It's all going to come down to inflation. I have clients saying, why would the Fed cut this year? Well, if inflation continues to decline, if inflation is at 2%, the Fed is likely to cut this year. Now, our view is no, inflation is going to get really sticky. I mean, it's easy to get that first couple of percentage point decline. For inflation to get to 2%, we need wages around 3%. So if inflation is going to be sticky, I think the Fed is really going to struggle to cut rates. So that 2-year has not only the end point of the hiking cycle, but all the cuts that are priced in. We're pricing in 200 basis points of cuts between the middle of this year and essentially 2 years out. What happens to that? I think is going to be a function of inflation. Our view is the Fed is going to hold still. They're not going to cut rates until they see wages close to 3%, until they see PCE close to 2%.
The exhaustion in everybody's voice today after this week is notable. It's palpable. And you said that this is the most confused Fed and markets that possibly you have ever seen. Where do you get conviction in any trade at a moment like this?
It's hard. I think you have to keep, risk positions light. I think the Fed has stepped down clearly, so volatility will be a little bit lower. But where's that end point? What do they do after that? All that is up in the air. I think we're going to have to go back to models. And a lot of people have less faith, including the Fed, I think, have less faith in models. The Phillips curve, does it exist? Why has inflation declined? So I think we're actually looking more at our models. We're looking at how do you get service inflation down with wages staying high? How do you get wages to come down? Does the unemployment rate stay here? So we're actually going back to econ one-on-one. But I can see for the market that's been used to forward guidance from the Fed and the ECB, we're getting no forward guidance. So I think the market's going to be whippy. You have to have these strategic trades, perhaps, like being long duration, for example, but have to be nimble around it. I think interest rates in the near term can rise because you talked about ISM services. That goes above 50. The consumer is still strong. Consumption of services is still strong. Then interest rates look too low. So I think we're trading it more tactically in the near term and having an eye on that strategic recession. Does the Fed cut rates? I think you sort of have to play it. You have to be nimble because the Fed is nimble.
Hey, Priya, wonderful to get your view, as always. Priya Misra there of TD, still looking for rates above 5%, still looking for a recession in the back half of this year. And Tom, ultimately, the Priya Misra call of the year, which was the end of last year, curve inversion through the whole of 2023.
Yeah, the duration issue is really important. If you take that chart back, I'm going to say pre-Volcker, I would suggest what she's calling for, to be polite, would be unusual, if not once in a lifetime. I mean, the depth that... Can we talk a social aspect?
Please do.
I'm watching New York City real estate. I'm not going to go into it right now.
Oh, no,
it's
please
really
go into
ugly.
it.
It's really... No, it's really ugly. Commercial real estate. Nick Bloom at Stanford is one of our best. We've had him on the show a long time ago. He owns a high ground on work from home. He's the one who's really, really, really looking at the math. The average has come down, the number of days work from home, and stopped. And it stopped at 2.3 days is what we're doing right now, work from home.
Is that the new normal now? 2?
You look at the chart, and yeah, it says new normal.
Do you think we could do 2 from home?
I think that we move the chart. I mean, there is a surveillance aspect to it. We're sort of like jaded and chart on this, aren't we? I mean, we're not thinking like most people.
Not at all.
Yeah.
Because we kind of have to be in the studio.
Well, yeah,
we could do it from
particularly,
home.
Wednesday sleeping here.
That didn't work out?
The marshmallows and the fire we did Wednesday
That was
night,
horrible.
For team bonding.
Sure.
But Lisa jumped into Kumbaya, and I teared up. I mean, it was really... After the Fed meeting,
singing at the bar?
Yeah, we slept
Lisa's
here.
Thing. Did you record that?
No, I did not. No, I think Chart Banner has it on Zoom.
It's like a fake fire in the middle here.
It was
Is that our campfire?
That's our campfire. They sort of changed to an orange hue.
No, this is like Trump and the Saudis. It's the white orb.
Children.
Do you remember that orb? Tom, I still don't know what that orb was.
The orb comes up and we all go Kumbaya.
What was that orb that President Trump had with the Saudis?
Don't know.
What was
they
that?
don't know. That's horrid.
When things were going well, it turned white, and when things were going bad, it kind of turned just like deep red.
Really? Did it change colors?
No.
Oh, Anne-Marie's got one in her living room.
We're done. At 11. Next hour.
Yes, Qantas, yes, I hear you. We're done.
Anne-Marie joining us down in D.C. up next.
We're lucky.
On a spy balloon. A surveillance balloon over sensitive nuclear sites.
I think we have to.
In the western United States. You know, what's the line of the morning from the Chinese government? I thought this was great. We're gathering and verifying the facts. We hope the relevant parties will handle the matter in a cool-headed way.
Who are the relevant parties?
As the surveillance balloon just drifts across the country. Cool heads will prevail here. Okay, that's next. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The U.S. labor market probably continued to moderate at the start of the year. Still, wage growth, historically low jobless rate, and high vacancies are expected to keep the Fed from lowering interest rates for some time. Today's jobs report is likely to show that payrolls rose by 189,000 in January. It's one of the most dismal outlooks ever produced by the Bank of England. The central bank says that workforce dropouts have become an economic deadweight, and they've left the UK facing its bleakest outlook in generations. The BOE doesn't see pre-pandemic levels of output returning until 2026. Shares of Apple are down after the company reported its worst holiday performance in 4 years. Supply chain issues and a softening economy hurt iPhone sales. Revenue fell 5.5% in the December quarter, Apple's biggest sales period of the year. Still, CEO Tim Cook sees signs of a rebound in China. And shares of Amazon are lower after the company announced consumer demand is slumping and sales in its cloud computing division will continue to slow through the year. Amazon Web Services revenue fell just short of estimates. CEO Andy Jassy says his #1 priority is to cut costs. And Ford is blaming poor execution and continued supply shortages for fourth quarter profit that missed estimates. The results show the company is struggling to balance the transition to electric cars from conventional vehicles. As a result, Ford will ramp up cost-saving efforts. Job cuts will be part of that, too. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
I think Kevin McCarthy's probably more important than Powell as far as the Fed easing cycle goes, and that's because of the debt ceiling. If you look at the last 2 big fiscal tightenings from the US, 95, 2011, around the debt ceiling, this could cause a recession. So all the market is doing is it's just applying some probability to fiscal tightening later this year, and that's why you're seeing these rate cuts being priced.
Joyce Saravelos there, the global head of FX research over at Deutsche Bank. Who would have thought, Tom, McCarthy more important than Powell to markets, apparently, at least in the view of Deutsche Bank? That's just a deep sigh on the research of Deutsche Bank. Lovely.
No, I don't mean Deutsche Bank. I mean the meeting. What do we know about the meeting? Nothing.
Between McCarthy and Biden.
It's bizarre.
No. The story today, you know what the story today is? Can we talk about the story today? We're going to anyway. There is a spy balloon, a Chinese surveillance balloon, over sensitive nuclear sites in the western United States. It's injecting new strain into the relationship. The pictures are phenomenal, incredibly clear. And this at a time just before we've got this planned Beijing visit by Secretary of State Antony Blinken. What's amazing is the way that the Chinese government has responded to this. And I'll share the quote with you from the Foreign Ministry spokeswoman. Said Friday that Beijing was gathering and verifying the facts and hoped, quote, the relevant parties will handle the matter in a cool-headed way. It's kind of unreal, isn't it? So here's the issue politically, and politics is often always about the optics. We're told this is not the first time, but for many people, this is the first time they're seeing it. And because of the optics around that, this makes it really difficult for Blinken to go to Beijing. What's ridiculous about that is it's not new and it's happened before, and Blinken was still going to go to Beijing. Which just tells you, Lisa, sometimes politics just comes down to one thing, optics.
Especially when we haven't heard Tony Blinken say he's not going to go, but he will cave once people start to really pressure him and say that this is crazy. It's also fascinating that China is saying, we hope cooler heads will prevail, even though, potentially they're, even though, potentially they're one of the parties. But, there is a dissonance right now between the administration politically and this and what's going on in Washington, D.C., and the business community and the rest of the economy that is highly dependent on China for a lot of the revenue.
It's a big issue, Tom.
Can we do a balloon surveillance correction?
Please do.
Helene Cooper, New York Times, corrects me. Thank you. Helene, she's got the path. I implied earlier that it came across the Pacific. It was a party balloon at the Waldorf Astoria in Shanghai and came directly across the Pacific, which is what an amateur like me would think. No, the New York Times reports, are you ready? China to the Aleutian Islands of Alaska, down through northwest Canada, over Maelstrom Air Force Base in Montana.
I'm so glad he corrected this.
But is this thing supposed to go over America? Anne-Marie Horton joins right now on this. And Anne-Marie, I'm glad I got the map straightened out. Is this one big accident? Can't we just say to China, did you do this on purpose?
Well, these are the questions at the administration. And by the way, I was aware of that flight path because the Canadians had come out and said that they did see this surveillance balloon and also that they're looking into, quote, another incident. So still we're waiting on more details of that potential second incident that the Canadians are tracking. But these are the questions the administration is asking the Chinese, clearly. And I think to John's point, the big question is whether or not Secretary Blinken goes on this trip. In mere hours, he is set to go on this trip. And what I really woke up thinking after, a number of phone calls and emails last night is this almost a trial balloon from Beijing to see how the U.S. reacts? No, honestly, to see how the U.S. reacts in this kind of instance and how, as John said, what the foreign minister says, will cool heads prevail, because the U.S. does want to make sure that they do have some lines of communication open and they put a floor in this relationship? Or is this messy planning? Did Xi Jinping sign off on this just days before this very important trip? Remember, a Secretary of State has not visited Beijing since October 2018. Or is this messy planning on behalf of Beijing?
We could play around with this all day. I'll try and ask a serious question. Anne-Marie, does this pose a physical threat? Does it pose an intelligence threat in any way, shape or form?
According to U.S. officials, the Defense Department, it doesn't. Not physical threat to any individuals, especially those over Montana where it was spotted, and as well as a harm in terms of intelligence. But the U.S. has deemed that it would be worse to shoot it down because of the debris that it could cause, and they do not want to harm any civilians.
Have we confirmed that there's optics on board? Seriously, Anne-Marie, have we confirmed that there's some form of legitimate imaging on board?
Well, the U.S. does believe this is a surveillance balloon, so it's not just a floating balloon. It obviously would have some sort of technology. But again, the Chinese are already doing this with low-level satellites. And there also are things called drones, which most people and most countries are using. So that is why this is so peculiar. Why send a surveillance balloon when you can do the same, and are probably already doing the same, with low-level drones?
Well, that's what I was
gonna, satellites.
Anne-Marie, that's what I was going to say. Don't countries all spy on each other? I mean, doesn't China spy on us all the time? We spy on China, and that's just how it goes.
Yeah, so the Chinese answer will be to this is that they have been complaining about U.S. spying, whether it is spy planes, whether it is spy ships, for over the past decade or so. So for individuals in the government, this is probably, nothing that surprising, but obviously it is taking the public by storm, and the optics are pretty terrible right now, given the fact that Secretary Blinken is supposed to make this trip. They're supposed to have a warming of ties when it comes to at least the communication part, but then you're going to have a tremendous amount of pushback, and you're already seeing it from the likes of Speaker McCarthy, from Representative Gallagher on the Republican side about why even having these overtures with China if they continue to do things like this.
That's what I was going to ask. What's the basis of warmer ties other than economic ones?
Well, there's the climate talks. That's an economic/environmental track. There's also the fact that there really has been a softer communication between Beijing and Washington when it comes to the military communications and those angles. And Bloomberg reported about a month or two ago that since Nancy Pelosi, former Speaker of the House, made that trip to Taiwan, that those communications have really been much more muted than they have been in the past. So it's not just economic, it's also about military ties. And we had Admiral Kirby the other day talking about the fact that this is the most consequential bilateral relationship for the United States and for the world. And when you talk to allies of the U.S., they want to see at least the United States speaking with China. They do not want this to become fraught. They want to at least be able to say at least they're communicating to avoid potential escalation of this relationship and potentially conflict, which we saw this week, or was it last week, that memo from a Air Force general in the Pentagon talking about a potential conflict between Beijing and Washington as soon as 2025.
Anne-Marie, just quickly, you mentioned it, but remind me, when is Blinken set to leave?
He's set to be there by Monday, so
By
sometime
Monday.
over the weekend. Yeah, so that's what I say. This is a huge question they have to answer, and I imagine we'll get an answer today.
Amazing, amazing. Anne-Marie, thank you. Down in
Thank
Washington,
you,
D.C.
Emily. Seriously.
What a story,
We're
Tom.
making jokes about it.
What a story.
It's a story of our relationship with China. And I'm going to go back even before 1947, 1948. There's just a distrust. There is a trans-Pacific distrust, which America and, frankly, a good part of Asia has had to deal with for decades, forever.
There is a difference, Tom, between making a relationship better and stopping it from getting worse. And I think the effort of Blinken going over, and the administration said it themselves, TK, was about putting a floor under the relationship.
Yeah.
That gets a little bit harder going into the weekend,
Well,
I
it's
guess.
it's just school of thought of diplomacy. You got to show up. And, there was a dearth of that. Somewhat. The critics of the Trump administration would say there was a dearth of that.
Will he show up?
Given the appearances, why send something so obvious, right? I mean, it's not subtle when you
says
send
it was
a
on
balloon.
purpose?
Well, but you think that they just accidentally did that for a party and then it flew over to the U.S.?
Maybe it was supposed to go over Fairbanks, Alaska. I don't know. Maybe it was going to Helsinki. People they go over the North Pole. They don't fly like Shanghai. It went over the Aleutian Islands in northwest Canada. Where's it go now? Does it go to Miami?
You think it might be an accident?
I don't know. I don't know. Where's it go next?
Okay.
Stay tuned.
Payroll's 60 minutes away. Equities lower by 0.7% on the S&P. On the Nasdaq, year to date, absolutely flying. A bit softer, negative, lighter, lower this morning. We're down 1.2%. Lisa's going to run through some of the stock names you need to be looking at after the close yesterday. Tech facing a bit of trouble after facing a fantastic year so far. In the bond market, we look like this. 2s, 10s and 30s shaping up as follows. Your 2-year, 4.0998%. Came close to breaking 4% yesterday. Yields just drifting lower, plunging lower after the Federal Reserve on a 10-year to about 3.39 at the moment. Going into payrolls, looking for something like 190k. Looking at euro dollar looks a little something like this. Chairman Powell says the disinflationary process has started. President Lagarde says risks around the inflation story becoming more balanced. Euro dollar, Lisa, 109.34, positive there, 0.2%.
How much more oxygen is there in that? I just wonder about that. Have we all priced in the best news that potentially could be there?
Got the China reopening story in the mix as well. So I heard from Vasilios Giannakis yesterday of Citi, who thinks that any pullback on the euro by the dip on the China reopening story, and I guess we'll see. I find it so difficult to forecast European growth. I don't know what's going to happen with the war. I don't know how difficult the next winter is going to be. I think a lot of people are optimistic based on how this winter went, and ultimately, how much growth, how much inflation do we ultimately import from China?
Yeah, and honestly, uncertainty is what's really been pervading all of the earnings that we've seen, too. We went over Amazon, Apple, and Alphabet earlier, and just the offset to yesterday's gains. But I wanted to take a look at some of the other reported earnings and what we've seen, and sort of the bifurcated nature of a world where money isn't free. Nordstrom shares up 26% in pre-market trading. Basically, meme stock activist investor Ryan Cohen evidently has built a large stake in the department store operator. The reason why I find this interesting is because activist investing is much more present in some of the tape now than it used to be as people start to look at where valuations have opened up. Ford, this is really consolidation of market share. We saw GM come out with really good numbers. Stocks surged. Ford came out with a pretty big disappointment. Those shares down 6.6%. And this, to me, raises a question. How much do we continue to see a consolidation among a few winners, even as a growing number of others become the losers? Qualcomm fits into that as well. Those shares down by 3.2%. Disappointing on sales, showing some potential new businesses picking up. But you're seeing this bifurcation within the chip sector with respect to Taiwan Semiconductor Manufacturing Company and Samsung really gaining market share. But John, you see the rest of them kind of losing and trying to find out what the new business model is going to look like. And I just, again, how much is this endemic of an environment where money isn't free anymore?
I think it's true of a lot of tech firms right now trying to work out the next act.
Yeah.
Which is why on the earnings call, Tom, you hear that a lot of them talking about AI. All of a sudden it's AI.
Yeah.
AI. As we look at deceleration in the cloud business.
They're hardwired to do that. I'm not really sure what to make of that. There's got to be some winning applications of AI, but you know, what's the other thing we're doing now? ChatGPT. GPT, yeah. You know, I mean,
that's where the job guesses came from this morning, Tom. ChatGPT.
Yeah, it's all the rage.
An hour away from the payrolls report for the month of January. The guesses look a little something like this: 190,000. Ellen Zentner has got a really fascinating call.
Gloom.
175 on payrolls, but Ellen Zentner looking for a pause, Tom, in March from this Federal Reserve.
It is a bit of an outlier call from Ms. Zentner of Morgan Stanley. She cut her teeth with amazing consumer analysis a number of years ago and has moved on to a broader, bigger picture of the market. She joins us this morning. Ellen, I'm going to go narrow on you right now. Ben Emmons, I think, writes it up beautifully at Newage Wealth this morning in that ADP showed some wage disinflation, and Mr. Emmons moves from ADP over to average hourly earnings and says the shock this morning could be a legitimate wage disinflation. Is that what the market's trying to get out front of and celebrate?
Well, I think that's where the market's focus should be, because the headline number is going to be wrought with a lot of backward revisions, annual benchmark revisions.
Yeah.
You know, the wage growth really is more important here. So it would be nice to see some downside surprise or disinflation creep in wages. Obviously, the employment cost index is the metric that the Fed's going to follow most closely, but average hourly earnings is higher frequency, and we need something to focus on. But I think the point around ADP is important, because you also have LinkedIn, you have Indeed. These are companies that have been coming out with their own monthly wage reports, and it does show that, yes, wage growth is still high, but that the rates of growth have peaked.
Bring that over to another outlier, Liz Ann Saunders at Charles Schwab, talking this up big, which is housing. At Morgan Stanley, with all of your national contacts, are you seeing rents in home ownership, inflation, again, come in?
Yeah. Now, we've been seeing the on-the-ground real data on rents have been declining since the fourth quarter of last year.
Give me a number there.
It's
from
the
7, 8, 9 to what?
Right. So, well, effective rents are different than what's in the CPI measure, but you're talking about 12% growth coming down to 7 or lower. In CPI, we want to see these extraordinary rates of rental growth that historically are closer to around 3-4% come down from where they're still around 6% or so, 6-5%. It's just too high, but the peak in that growth rate is in. We just need to see more of those declines. Now, in a lot of cases in this labor market data, we've had evidence on the ground from different sources for quite some time that wages would be coming down, that rental prices would be coming down, and it's taking quite some time for it to show up in the government data. Is it showing up now, and will it show up in a bigger way? I think so. But pinpointing the exact month that things start to really snowball is difficult.
It's super difficult. I think one thing we've all heard on this programme, our audience have heard it as well, is that to get inflation back towards target, we need to feel some pain. Chairman Powell said that in Jackson Hole. There needs to be some damage. Yet we look at unemployment at 3.5% and claims at 183,000, and we all ask the question, where's the pain, where's the damage? What does that tell you, 183,000 jobless claims? How much signal is there for you?
So the signal there is that companies have been telling us that they're going to hoard labor. It took so long to even right-size payrolls. It was difficult to hire. So in this downturn, there's less, downturn in the labor market, there's less jobs to let go. It's more that hiring will slow. And so you're seeing that, and that jobless claims are not rising. Now, that makes it more difficult to estimate monthly change in payrolls because we're not letting people go, and initial jobless claims are usually the most powerful indicator in your model when you're trying to forecast these monthly reports. But companies are not laying off broadly. We can set tech aside. It's a special case where they overhired during COVID. But broadly, we're not seeing layoffs. So it really comes down to just how slow will hiring be.
Does that make it harder for the Fed to hit its objective, or does it not make a difference?
I don't think it makes it more difficult. I think what we're seeing is that the reason why wage gains have peaked is because job switchers have declined, right? So churn in the labor market is shut down. The economic environment is too uncertain for people to keep switching jobs. And that's where the wage gains were pushed up the most. So I think it's more churn that's helping wage gains slow. But what I liked about the press conference this week was that, and I believe it was your Mike McKee that asked this,
okay.
Why have you been able to, why are we seeing disinflation? Why are we seeing that wage growth has peaked, that rental prices have peaked? Why are we seeing that, and yet the unemployment rate is still very low? I don't know if Larry Summers is wringing his hands over this because he was saying that you're going to have to do significant damage to the labor market in order to get inflation to slow, and yet inflation is slowing and the unemployment rate is still low. I think that is an excellent outcome for the Fed.
Perhaps when he talks about the minutia of economics, it was a very successful press conference. If you're looking at a tightening of financial conditions, which ostensibly was a goal for the Federal Reserve, it was not a good press conference. Does it matter when it comes to the fundamental economy that financial conditions are loosening? Does it push the Fed further away from their goal?
So it's a really good question, and they are very focused on financial conditions. I think certainly if you're a policymaker and you look at financial conditions, you look at the unemployment rate that's still low, you feel that you can go further with the policy rate, and markets can withstand that. But here's what I think they should be focused on. Financial conditions had an extraordinary run of tightening all the way through October of last year. That is what's impacting the economy now, where we're tracking just 0.2% GDP growth for this quarter. The easing that we've seen in financial conditions since October will be more of what supports growth in the back half of the year and will help the market grab onto that soft landing narrative that we've been pushing for so long now. So I think that's how we should look at it. I don't think they should be so disappointed that financial conditions have remained easy right now.
Which perhaps is the reason why we're not going to see big pushback. What's the difference between disinflation and getting back down to 2%?
So it's just the speed at which we get back down. Disinflation is that prices are still growing, but they're growing more slowly. And so in the Fed's own forecast, they believe it's going to take quite some time to get back down to 2%, that disinflation will prevail over the next couple of years and get us there. I think what we're seeing in market pricing is that based on the latest inflation data, the expectations that maybe we're going to get down or see a faster pace of disinflation and get down to the Fed's goal faster than they think. And that's what the market is betting on.
The heritage of the Morgan Stanley's Richard Berner with a lot of acuity and analysis. Ed Hyman at Evercore ISI's years at C.J. Lawrence, the same idea. Hyman is modeling sub 3% inflation. You just Lisa's question, I thought, was dead on about the stochastic nature of disinflation coming down. Is this like any other disinflationary cycle in that we completely underestimate the rate of change to get down to 2.x% inflation?
Look, well, I wouldn't say in every cycle because inflation is typically a very slow-moving beast, and it's been pretty easy to forecast the disinflation that continues even after there's a slowdown or a downturn in the economy. I think This time we have to be humble because just as we missed it on the way up, and it kept accelerating beyond expectations, you could have that happen in reverse on the way down. Something that Chair Powell talked about was the goods deflation, where goods prices are actually in decline. Well, if you think that that's just temporary, he used the word transitory again. God forbid we use that word again. But then you want to look at everything outside of that and say, okay, take away all the special factors. Are we just simply getting a reversal of COVID-related factors, or are we getting true disinflation more broadly? I think we are getting true disinflation more broadly, but that's not as pronounced as just the COVID factors that are coming off right now.
Just quickly, Chairman Powell speaks next week. Is there any kind of clean-up on aisle 4200 on the S&P right now? Any kind of clean-up act whatsoever that he needs to conduct?
Look, I don't think there's anything there. I think he can continue to harp on financial conditions being too easy. But right now, the market's pricing in a March rate hike. The Fed believes it's going to deliver a March rate hike. So where's the pushback?
You're looking for the pause and 175k at 8:30 Eastern. Alan, love it. Great to have you with us.
Thanks.
As always. Alan Zentner there of Morgan Stanley. Your payrolls report just around the corner. Next stop, 8:15 Eastern time, about 30 minutes from now. Neil Dutter of Renaissance Macro. The constructive view on an economy that's about to pick up for Neil and maybe a Fed that might be pulling back too prematurely. That's Neil's view coming up.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Today's U.S. jobs report may show payrolls rose last month by the smallest amount in more than 2 years. Estimates say the economy added 188,000 jobs in January. Still, wages are expected to keep rising, and the jobless rate is near a 5-decade low. All that's likely to stiffen the Fed's resolve to keep rates elevated for some time. The jobs report out at 8:30 New York time. The U.S. will send Ukraine a new ground-launched bomb-tipped rocket. That's part of the latest military aid package. The weapon is made by Boeing and Sweden Saab. It won't be deployed in Ukraine anytime soon. It will take about 9 months for the first deliveries once the Air Force issues a contract. Next week, for the first time in 3 years, the border between Hong Kong and mainland China will completely reopen. That's designed to revive the city's role as the business gateway into the country. Daily quotas and COVID testing requirements will be dropped. Hong Kong will also allow unvaccinated travelers to enter the city. And shares of Nordstrom are soaring. Bloomberg has learned that the meme stock investor, Ryan Cohen, has built a sizable stake in the department store chain. He aims to replace at least one of the company's board members. Last month, Nordstrom slashed its annual profit guidance after sales decreased during the holiday shopping season. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I actually think the March meeting is going to be really interesting for the ECB, and it was Chair Powell that made it that interesting. So when you look at the market reaction today, I think what they're telling us is that string of hawkish central bank meetings is over.
It is over. Ibrahim Rakbari, Chief Currency Strategist at Citigroup. That's Ibrahim's view, not mine. Equity futures right now on the S&P down about 0.6%. Going into payrolls, 44 minutes away in New York City. We've got a bond market that looks like this, 109.34 on FX. That's euro dollar. Tom, in the bond market, 339. We're unchanged in the bond market, basically unchanged on euro dollar. Just a little bit of a stronger euro in the mix. Still waiting for German CPI. You mentioned that, Tom, earlier in the programme. I think maybe next week. You might get that release of German inflation. But ultimately, the takeaway, to Ibrahim's point, the Fed's lined up. The ECB's lined up. They're starting to see a trend that perhaps they can enjoy. They don't know if ultimately it materialises in a favourable fashion, but it's new. They're acknowledging it, but they're still trying to state their work's not done. They've got more work to do. But I just don't think many people are listening to that anymore, Tom.
They're going to listen to the jobs report here. And I thought
without a doubt.
What Ellen Zentner said about wage dynamic and what Ben Evans wrote about this morning for me is front and center. This is what surveillance is about, and it's been an exhausting 3 days for us, and our team has rallied to give you perspective. We just spoke with Ellen Zentner of Morgan Stanley. We will speak with Neil Dutta of Renaissance Capital, somewhat on the same page. Dutta's the arch optimist. Zentner carefully sets a Fed below 5%. And then in the middle is Anna Wong, who had an historic call as chief U.S. economist for Bloomberg Economics, I'm going to say 12 months ago, saying 5% and above. Anna Wong joins us right now. Boy, the dialogue, Anna, the thought I heard in Washington was you falling off your chair in the middle of the press conference. How did you, with your framework of a Fed to 5%, react to the Powell presser and the market reaction to it?
So I think Powell made the mistake of behaving too much like an economist. I think the substance he delivered is very much hawkish. He talked about how, the super core inflation, services, ex-housing, has not shown any sign of disinflation, which is what we're seeing as well. It's steady at 4%. He also talked about there's more risk of doing too little than too much. Market didn't hear that, but what market heard is the tone, the lack of conviction in what he said. So I think my framework, our framework always has been we estimate a reaction function of the Fed, right? I think Powell confirmed that their reaction function has not changed. It's really the input into that reaction function. So markets thinks that, the inflation is falling to low twos and the Fed does not. They have the core PCE going to, 3.5 or above this year, and the market basically imply that core PCE would go down to 3, low 3s, or even below 3. So I think even maintaining that same reaction function that the Fed has, if unemployment rate should go to 5% at the end of this year, according to that reaction function, the Fed will cut by 50 basis points, which is what the market wants.
To me, what's critical here is in the jobs report that we see here in less than an hour, you're going to look at the wage dynamic. Can you adjust your terminal rates down if we get a quiescent wage dynamic this morning?
Definitely not. So we have seen in the past couple months that the data on average hourly earning is extremely noisy. And on top of that, they are revising the seasonal adjustment factors and all that in this January report. It's still up for a lot of revisions. And, we saw that the November alarming average hour earning rate was completely revised away in the December report. So in the March meeting, the Fed will still have 2 more CPI report. And by the May meeting, they will have another ECI report. They will put a lot of weight on those. But I think the significance of today's wage data would be how market react to it. If it's slower than 0.3%, then I think the market will extend the rally from the post-FOMC.
Anna, let's connect the markets and the economy. We're just speaking with Ellen Zentner of Morgan Stanley and asked her the connection, whether the loosening in financial conditions we've seen on the heels of the Powell presser will make any difference to the economy, works against them. And she said maybe not, because we've already seen enough tightening to really affect the change that they would like to see. Do you agree?
Yeah, I would generally agree with that. I think what Powell is seeing when he said that financial conditions has tightened significantly, or the same as December, is looking at the real yield. So if inflation is falling faster, then even though nominal 10-year yield Treasury is going down, inflation is falling faster. So from the Fed's perspective, the real yield curve is, on the whole about the same. So that's what they're paying attention to, not to any kind of financial condition index by, Bloomberg or Goldman Sachs.
Well, but this is important, Anna, because we're all sitting here saying, it was a mistake. He was too nuanced. He had a shift in tone. He seems like risks are more balanced. And yet you and Ellen Zentner seem to be saying, no, he reflected the, economic thought as best as he can. He doesn't know how it's going to play out. And the markets, if they rally, that's going to be their problem, because ultimately it doesn't really feed back on the economy to such a degree. So if that's the case, does that mean they're not going to job on this market anymore unless the situation dramatically changes?
I think Powell is based, recall that at some point he said they care about the broad economic, financial conditions, not short-term financial conditions. So I think that if the Fed's view that inflation will stay high for a while is true, then ultimately the Fed will hold rates higher for longer and financial conditions will tighten, the rally will go away. And so I think that's the kind of context that Powell is in, and if the markets turn out to be right, then the current rally would be justified, and it could help him achieve the soft landing that he wants. So I think he's just kind of cavalier about financial conditions because it will naturally tighten if the Fed's point of view turns out to be right.
Anna Wong of Bloomberg Economics. Anna, thank you, as always. Just the difference between what an economist hears and what an investor hears.
And this is what it's about, folks. Zentner, totally different than Wong. Wong, totally different from Dutta. And that's a conversation into the weekend. I love doing this.
There is a change.
I got goosebumps.
There's a change from Chairman Powell. There is a change.
Yes.
Just compare and contrast. Say the bookends, Jackson Hole to where we are right now. Look at the arc.
We have more data.
The meetings in between. The Brookings
China's
interview.
Opening.
It's become way more balanced about the risks around monetary policy decisions. Way more balanced. Don't you think?
So here's the really key question then. He might be moving more toward the markets than the markets is toward him, right? Maybe underneath it, he and other economists believe in the Ellen Zentner view of things, where basically you see this disinflation moving perhaps a little more quickly than they previously expected.
He had the opportunity to validate the December dots. Didn't take it.
No.
So isn't there something in there? Isn't there some information to take from that? The fact there wasn't any real pushback?
Right. So I do wonder what the discussion was, and I am curious to read the minutes. And I know that, Tom, you may read the minutes, but the minutes are actually going to be fascinating this time
I'm serious. I may actually read the minutes for the first time in my life this time around when I get done with War and Peace. Mike out on Twitter with a brilliant Bramo chart. And this is something we haven't talked about in the 3 angry days we've had here. We've talked full faith and credit.
Who's angry?
We've talked I'm angry. We talked dissent. I'm talking equity markets. I'm talking full faith and credit. We haven't talked the land of Bramo. And Mike, thank you for your chart out on Twitter. Thanks for watching and listening. Bramo spreads are talking, aren't they?
Actually, this to me caught my attention
the industrial,
as well.
The B double,
because you look at
B,
investment grade, you also look at high yield, and basically this is the credit portion, the potential credit risk portion of the dynamic. Contracting on investment grade to the lowest going back to April of last year. You saw the biggest one-day decline in spreads on high yield bonds going back to November of 2020. So a massive bet on this belief in easier monetary policy and the potential boom that you would see subsequently in credit.
386 on spreads.
Yeah.
386.
And so to side, I guess it's related. Lagarde yesterday had to enjoy Italian spreads and actually nominal Italian yields.
What was that yesterday? A 40 basis point move?
Explain why that's important to our American audience. Besides,
I think they're well aware of why that's important. Once again, it's an easing of financial conditions because they believe after the next meeting, 50 basis points, they might be done. They might be done, and maybe the Federal Reserve will be as well. What's crazy about this move in high yield is we started the year, and I'm looking forward to catching up with Rick Reeder at BlackRock around 9 a.m. Eastern time with Mohammed Al-Erin as well on this. We had this beautiful fixed income breakfast buffet, and everyone was ready to load up. It was looking great. Juicy yields, fantastic. 1 month later, where's it gone?
Well, that's a great question. And you hear people reassessing the bet. And yet, the fear of missing out is very present because people said recently the gains were in and then it gained more. So what do you do with that?
Well, I think to some people's view in fixed income right now is even if it backs up, there's just going to be another truckload of people ready to buy back in.
Unless inflation surprises to the upside. And that's why the payrolls report's going to be important.
Or growth breaks down.
Yeah.
And that's a big risk as well. Through the next couple of quarters. Payrolls.
That was Sergio Bramo.
34 minutes away. Neil Dutta's going to balance things out in about 20 minutes.
Real rate projection both the market and the Fed has is actually pretty similar. The difference is just on inflation.
There's going to be an accelerated decline in inflation in the second half of the year.
I think the jury is still out there that we can be comfortable and complacent that inflation is on the way down, all the way to targets.
The ECB has an inflation mandate, and I think it's likely to reinforced that pretty clearly. They are still worried about inflation at this point in time.
What is clear, the ECB, having started later, still has some more room to go to the upside than the Fed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Television and radio, Jobs Day 3. Exhausting, fascinating days. And we sum it all up here, John, in this hour at 8:30. And I'm going to go right to it. For me, what matters is wage inflation reporting.
Well, I've got to say, Tom, it's certainly been more exhausting if you were short this market and not long, because it has been painful, brutal.
Or even cautious on this market. It has
so
been
difficult.
Painful. Totally agree.
To sit this out, Bramo, almost impossible. And that's where the FOMO starts to kick in. This is where the data might put an end to it. Payroll's 29 minutes away. We're looking for 189K. Chairman Powell doesn't want to shape your forecast. It will come down to this, the income and information.
Yeah, although at what point do people just interpret the data as they wish, right? And then we've seen this again and again, right? That basically people derive the message that they want. And we saw that from the meeting that we heard from the Federal Reserve. Some people took that as absolutely the dovish pivot that everyone was looking for, even though he basically said, we plan to do more.
If you sprinkle in some hawkish language that I've heard before and it tastes the same, but then you give me something new, a splash of something different, that's what I'm going to pay attention to. And that's what I'm paying attention to, and that's what everyone's paying attention to. You can't sit there in a news conference and say, we think the disinflationary process has started, and expect me to ignore that and just pay attention to, we got more work to do, we got more work to do. No, that is a shift. That is a shift, and I'm going to go back to what England has said at Standard Chartered. It doesn't matter what I think about this. Steve England has said, we've moved away from unconditional hawkishness to conditional hawkishness. It will come down, Tom Keene, to the data.
Conditional data dependency is maybe the phrase I would steal from Dr. Englander as well. What I also see on this is earnings, and I get the hand-wringing, Lisa, over tech and all that, but as I stated earlier, the modeled FA screen on the terminal right now for the Big Four, good morning, Scott Galloway, is $255 billion of free cash flow generated by four big companies. I find the stock market angst just ridiculous.
Well, cash flow is unassailable. They have incredible cash-producing skills. They dominate industries. They dominate the economy. However, what have we priced in terms of future growth based on zero rates that possibly isn't possible in an era of money that costs something and at a time where some of these technologies are normalizing? And I think that's where really the question becomes.
In defense here, John, of the gloom, and Ellen Zentner alluded to this just for her GDP call, I believe, for this quarter is pretty tepid, to say the least. With the disinflation, which is price up, yield down, with the disinflation that's NASDAQ 100 to the moon, is the idea nominal GDP comes in because the growth isn't there and the inflation component comes down as well.
Do you want the perfect quote? Here's the perfect quote. A window of opportunity when long-term interest rates typically fall prior to the magnitude of the slowdown being reflected in earnings estimates and the economy. This is the classic late cycle period between the Fed's last hike and the recession. Do you want to know who that quote belongs to and when it's from? Mike Wilson, November. That reads almost exactly precisely a description of where we are.
Yeah.
Right now. Like right now. And I remember at the time when Mike put that out, and of course you're all aware he's bearish right now in this equity market. When Mike put it out at the time, was leaning into the bear market rally of the moment. The question we were all asking is, how big is the window? How big is the window? And there was a feeling maybe it went into year end. Maybe you were a little bit too early if you thought it closed then, because it's still open right now. And I think that work, and I hope Mike doesn't mind me doing this, the work from November, I think is kind of appropriate to the moment we're in right now, so I'll share it again. There is a window of opportunity when long-term interest rates typically fall prior to the magnitude of the slowdown being reflected in earnings estimates and the economy. This is the classic late cycle period between the Fed's last hike and the recession. So even if you believe there is a hard landing, there is a decision to make. Do you want to participate in the rally, and how big do you think the window is?
No, we're going to have to see on it. I mean, it's just, to me, everyone over the weekend off of what we're going to see, John, in 25 minutes is going to recalibrate and readjust. John, I'm looking at futures negative 21. And, John, I got to go to the Bloomberg Financial Conditions Index, which has been resilient and accommodative.
Oh, today. Chairman Powell says it's unchanged, Tom. Financial conditions haven't changed much. Futures a negative 0.5%. Yields are unchanged, TK. Let's call it 340 on a 10-year. Euro dollar positive.
Sort of stasis.
0.2%. 109.35. We're about 25 minutes away from payrolls. The number, Tom, the headline number, our median estimate, 189,000.
A perfect equity market guest to get us into the economics of Michael McKeene. Neil Dutta will be joining us as well. Nadia Lovell joins us right now, senior U.S. equity strategist at UBS, steeled in the math and physics, the STEAM program out of Smith College, where it's 42 below zero this morning, I would suggest. Nadia, I want to go to the physics of this stock market. And you know that usually time in physics is squared. We have seen a massive squared time function across January and into February of a buoyant stock market. How does that end?
Yeah, we don't think it's going to end well. Of course, the rally so far has surprised us. I mean, coming into the year, we sort of had expected the economy to slow and to see more earnings cuts and the Fed to continue to hike. And the economy is slowing, and we are seeing those earnings cuts. They just not happen as fast as we would like to see them, but the market doesn't seem to care and ignoring that. Clearly the market is pricing in a soft landing, as well as optimism around potential cuts in the back half of the year. And so what that is saying to us is that the market expects inflation to come down quickly to the target and a recession to be avoided. We just don't think that both is going to happen. It's very difficult to see that. And even if it does happen, when you think about inflation coming down quickly, what does that mean for corporate top-line revenues? We think that revenues are going to decelerate faster than costs, and that's going to pressure margins. So either situation, we think that equities will be stuck between a rock and a hard place, but acknowledge that the returns that we had been looking for in the back half of the year has been pulled forward to this first half of the year, and we think that there is going to be some give back. So we think that window is closing.
Well, and that's where I was going to go to build on what Sean was talking about. How much further does that window have to go? Do you play in that window, or do you just sit on your hands and wait for something to happen that looks more akin to your projections?
We think that there's going to be probably some pullback in the market in coming weeks. Of course, a lot will depend on the 8:30 data, and we'll be watching average wages very closely, as well as I think also the ISM services data that will come out later this morning. So that's going to be important. But when you look at it from a valuation standpoint, Lisa, we now have a market that's trading above 18 times forward PE. Even if you can squint your eyes and close your eyes and get to 20 times forward PE, which is a lot, that's 4,400 on the S&P. So from that standpoint, there is not a lot of upside to the market, even in that scenario. And we think that there's going to be risks to the downside.
We just saw tech earnings from the giants. We saw varied performance, still producing a lot of cash. However, perhaps the astronomical growth is waning just a bit. How do you assess what's priced in terms of interest rates versus profits?
A lot is priced in, and you can see that from the valuation standpoint and the premium that tech is trading at. And you would think that the environment is quite rosy for tech. And as you have noted, the earnings results have been quite missed, and the forward guidance actually has been below expectations. I mean, you're also even seeing profit-less tech rally in this market. I mean, we do acknowledge that companies are becoming more efficient, and we are more focused on those companies that are focused on improving those efficiencies, also removing some costs and controlling CapEx in order to protect margins and free cash flow in this environment. You want to focus on those companies that have more enterprise and recurring revenues.
Nadia, you came out of college and you drank the Kool-Aid of the Capital Guardian Trust Company of Los Angeles and American funds. You were weaned on knowing you got to be in the market. If I have a Nadia level view, which sector do I hide in this market?
Yeah, I agree. Like this, you have to be in the market in order to participate. I think there in energy, this pullback that we're seeing in energy, we're surprised not to see oil prices higher given how fast China is reopening. But we need to see some of the more import data from China. And those companies are producing a lot of free cash flows, raising their dividends and returning cash to shareholders. So we think that, this pullback is an opportunity there. I think you want to have a more balanced view on this market in terms of exposure to some of the defensive areas and also the cyclical areas. And I think also you might want to look at some, protection strategies in terms of protection to the downside, but to be able to participate in the upside should this market continue to rally.
Nadia, thank you, as always. Nadia Lovell of UBS Global Wealth Management. FOMO's an amazing thing, isn't it? The fear of missing out is so powerful.
Oh, yeah.
TK, you'll like this. I think the stock market is that classic Veblen good. where demand for it increases as the price goes higher. It's just one of those things that markets I find just really odd, because in everyday life, the way we behave about any good or service is that if we see it on sale, we'll want to buy it. And if the price goes up, we'll be shy about going there. And with markets, it's kind of the opposite. People have this fear of missing out on the way up, and on the way down, they're like, well, no, I'm out.
Stocks are all about the story, right? So
Always.
the story
Right.
when they go up is a lot better than the story when they go down, even if the profit perspective is perhaps a bit better.
Yeah, Veblen good, folks, to translate this is there's that scarf or those shoes you want at Louis Vuitton, and they go up in price and more people buy them.
Yep.
I'm interviewing Richard Clarida in the library of the Eccles building at the Fed. They have the mother of all economic libraries. I'm here. Clarida's here on radio. I'm describing this. I'm 3 feet to my left is the libraries, and they have a first edition of Torsten Veblen.
That's real money.
On the Veblen good. I said to Clarida, I said, when everybody's not looking, I just want to take three or four books.
This is the act they've missed. Never mind the classified documents. You want the first edition books.
Yeah, you want...
No one's listening, Tom, so keep talking about stealing them from the Eccles building.
They got the library at the Fed, folks, is spiritual. It's just fantastic.
Very
quality.
Cool. Neil Dutter's coming up about 4 minutes away. He's going to be around the table with us,
Veblen
going into
skated
payrolls
from Montreal.
and coming out of payrolls. We'll discuss them with Neil. Your payrolls report is about 18 minutes away. We're looking for 189K. From New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. As Jonathan just said, the clock is ticking before we get our latest look at the strength of the U.S. labor market. The January jobs report expected to show that the economy added 188,000 jobs. Now, that would be the smallest gain in just over 2 years. Still, it illustrates resilient labor demand that favors a soft landing for the economy. It's one of the most dismal outlooks ever produced by the Bank of England. The central bank says that workforce dropouts have become an economic dead weight, and they've left the UK facing its bleakest outlook in generations. The BOE doesn't see the pre-pandemic levels of output returning until 2026. Next week, for the first time in 3 years, the border between Hong Kong and mainland China will completely reopen. That's designed to revive the city's role as the business gateway into the country. Daily quotas and COVID testing requirements will be dropped. Hong Kong also will allow unvaccinated travelers to enter the city. The U.S. will send Ukraine a new ground-launched bomb-tipped rocket as part of the latest military aid package. The weapon is made by Boeing and Sweden's Saab. It won't be deployed in Ukraine anytime soon. It'll take about 9 months for the first deliveries once the Air Force issues a contract. And shares of Apple are lower after the company reported its worst holiday performance in 4 years. Supply chain issues and a softening economy hurt iPhone sales. Revenue fell 5.5% in the December quarter, Apple's biggest sales period of the year. Still, CEO Tim Cook sees signs of a rebound in China. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We don't have a very consistent Fed at this moment. What we ended up having is a disconnect between Jay Powell and himself. Labor market is still very, very tight. And I think the jury is still out there that we can be comfortable and complacent that inflation is on the way down, all the way to target.
The fantastic Wei Li, the global chief investment strategist over at BlackRock. We are 14 minutes away from a jobs report in America. The median estimate in our survey, 189,000. And take a look at markets, just erasing some of the losses on the S&P 500. Still down by 0.4%, but well off the lows. In the bond market, yields not doing much, Tom. 338.67 on a 10-year. Euro dollar doing something, a little something, positive 0.2% at 109.35.
But it's a calm setup before before this jobs report.
The calm before the storm.
It's like a readjustment after the festivities of the last 2 days.
It's an important data point, Tom, and I think reflecting on the data we've had so far this week, ECI a bit softer.
Yeah.
That got the rally going.
Nice
Jobless
job.
claims, Tom. Yeah. Jobless claims at 183,000, just amazing.
In a 4-week moving average, it's stunning. I would note the VIX, John, to 17.06 shows the bullish ferment that is out
Speaks to the rally we've had year to date.
Speaks to it. Michael McKee, ready to give you the data here. We'll touch on the report here in a number of minutes with him. But right now, we are thrilled to bring you Neil Dutta, head of U.S. Economic Research at Renaissance Macro. He has been more than optimistic. The market is confirming the Dutta optimism as well. Neil, within the jobs report, it seems like the wage dynamic is so important. What is the Renaissance Macro view of the use of average hourly earnings here in 12 minutes?
Well, certainly it's useful because of how frequent it is released. Now, obviously, I think like most economists, I think the ECI number that was released earlier in the week is more significant, and that does show some moderation in wage growth. I do think the broader issue, at least as far as I see it, is just how far we can push the kind of immaculate wage disinflation story with the labor markets as tight as they are. Sure, there's a little bit less churn in the labor market. There's not as many quits, so companies don't feel the need to bid people up as much as they had. But, ultimately, if economic growth is remaining healthy and in my view, potentially running above trend in the first half of the year, there's scope for the unemployment rate to drop a little bit. And obviously, if that happens, that can sort of further push up wage inflation.
So, Neil, do you think the Federal Reserve is on the brink of declaring victory too soon?
I think that's certainly a growing risk. If you didn't think that, before Wednesday, I think you should be thinking it's as more of a possibility after. I mean, I thought for me, the most interesting was just Powell's characterization of financial market conditions. He said that they've tightened considerably over the last year. I think, that's debatable. I mean, certainly real interest rates are higher than they were a year ago. But, if you look at things since, let's say September, there's been a significant easing of financial market conditions, whether you think about corporate credit spreads, whether you look at the broad dollar exchange rate. Obviously, equity markets have kind of revived here, and interest rates are down. I mean, one of the things I find most interesting within the financial markets is just interest rates are coming down. Look at what home building stocks are doing. If it was a recession, you'd expect rates to go down and home building stocks to tank. That's not what's happening. So what that's telling you is that builders are going to be able to make things work here. That's why their stocks are going up.
Neil,
sorry, go ahead, Lisa.
No, Neil, what you're dealing with, and you put this really well, is this powerful combination of both a Fed that potentially is close to done or even done raising rates and an economy that seems to be incredibly resilient with signs of even real strength in certain pockets. How long can you just ride that in the stock market?
Well, I think you can ride it for a little while. I mean, there's a lot of institutional inertia behind the Fed. I mean, they're not going to come around to my view after a couple of months of data. It's going to take some time. They're still very much wedded to the idea of the economy slowing down. No mention of the fact that auto sales just surged. I mean, think about what that's going to do to estimates of GDP. If you assume that auto sales are basically flat for the next 2 months, then motor vehicle consumption will add about a percentage point and a half to GDP growth in the first quarter, and your own Bloomberg consensus sees growth coming in flat in Q1. So,
I want to get to you just because we're going to go to McKee here. I think John Farrell's going to go to Mike McKee here with a little jobs preview. Neil, this is really important. With your optimism, we get the inflation component of nominal GDP to come down along with some form of growthiness. Am I right that whatever inflation does, Neil Dutta thinks real growth will be tangible and is underestimated? Is that correct?
Yeah, I think the composition of growth will improve in the first quarter, but that doesn't mean that the inflation issue is resolved. I mean, you can make a case, I think, for some upside risk to inflation. I mean, as an example, used car prices are probably picking up in the first quarter. The dollars come off. That may mean that the prices for imported consumer goods pick up. But, again, I mean, the Fed sees these things too. And again, they're stepping back. They're signaling that closer to the end. So, I think the issue for market participants is, look, I mean, growth is holding up. I mean, you don't have to buy into my idea that the economy is accelerating, but growth is holding up. Inflation's still elevated. Global growth is certainly picking up. The Fed's not really willing to short circuit any of that. And so that kind of, I think, puts a bit of momentum behind risk appetite here.
Neil, 8 minutes away from the number. Let's just wrap it up there. I know you're going to come back after the print to talk about it, but what are you looking for? We've got 189,000, the median estimate. Based on what you've seen so far this week, does it deliver some upside risk to the print, some downside risk? How are you thinking about that?
I think that there's some upside risk to the print. I mean, I do think there's a bit of residual seasonality in these numbers, but what's interesting to me is what will happen with the work week. Obviously, that's been something the bears have latched down to, over the last few months because obviously it's been going down. I do think that manufacturing activity is likely bottoming out, if not picking up somewhat in the first quarter. So I'd be keeping an eye on the manufacturing work week. You may be surprised to see it pick up.
Interesting. Neil, stay close. Mike McKee around the table with us. Mike, let's talk about it. 7 minutes away. What takes your fancy? What are you focused on?
Well, a couple of things we need to keep it in mind. One is that this is January, so they are redoing the data on the household, on total population. And that means that the household numbers are not going to be comparable to December. So when we get the two numbers, don't try to compare January and December. We have this issue every year. But the thing that everybody's going to focus on is average hourly earnings, because it's inflation that the Fed is worried about at this point. And we've seen a decline in the rate of inflation. We saw unit labor costs go down in the fourth quarter. So if that trend continues, that's going to make the Fed feel a little bit better. You asked Neil what he's expecting, and he said there's some upside surprise. That's the Wall Street view. We have the whisper number out at 198. Yes, so significantly higher.
Do they do an average?
People are thinking, so you can see there, people are thinking that it could go.
The help radio here, the white line moving up is the whisper number?
Yeah.
Crazy. Did they do whisper numbers like on average hourly earnings?
Not on average hourly earnings, but I think they may do it on unemployment rate. Although that changes so little that it would kind of not be a dramatic chart.
We've heard a number of economists come on our show and say really what's going to get the Fed's attention is if we get a sub 100,000 print for several consecutive months. How far away are we from that? Is that something that the Fed is looking at as sort of a line in the sand as well?
I don't think they're looking at it as a line in the sand, because at this point it's really about wages and wages pushing up incomes. We saw for many years growth in the 200,000s range every month and no inflation. So it doesn't really matter so much the size as whether people are paying up to get those workers. Now, how many workers do we need as a replacement level? 100,000 was sort of the view for a long time, but now David Wilcox, our head of U.S. economics, says 30,000 is all we need because the labor force has shrunk. So you got a long way to go before you'd run into any kind of issue.
And Zetner was touching on some of that, Tom, just the structure.
But I've never heard that number, ever. And Wilcox, by the way, folks, is a horse. I mean, this guy's the real deal. Yeah.
Mike McKee's the real deal. It's going to stick with us.
30,000.
The jobs number just around the corner, Lisa, 189,000, the median estimate.
Too. Keep an eye out for weather, because ADP said their number was bad because of bad weather.
Balloons over Montana.
Yeah, exactly. Look out for the weather. It's going to get real cold.
It is cold outside.
Thank you. Because we have this argument every single winter.
I know.
Where Tom just goes, it's not cold.
It's not cold.
If it's not 1950, it doesn't count. Like every single winter.
Pretty much evergreen statement on a lot of things.
Every single winter. Your jobs report up next. Neil Dutter, Jeff Rosenberg, Mike McKee on deck. Payroll seconds away, 20 seconds away. Equity futures going into it lower by 0.5% on the S&P 500 after a monster rally to start the year. In the bond market, your 2-year unchanged, a little north of 4% at around 4.1%. Your 10-year yields coming a basis point. Your 10-year right now 3.38. With the jobs report here in New York City alongside us is Mike McKee. Hey, Mike.
Well, good morning, John. We're just waiting for the numbers to drop here. They're starting to come out. The unemployment rate falls to 3.4%. And I'm saying, oh my goodness, because look at the jobs created. 517,000 jobs. I don't think there was a weather effect there. And this kind of doesn't make ADP look great. So 517,000 jobs created. Private payrolls up 443,000. 19,000 manufacturing jobs. So those who were looking at the ISM reports and thinking that the manufacturing was shriveling and dying, not happening. As I mentioned, unemployment goes to 3.4% from 3.5%. And it looks like average hourly earnings come in as expected, 4.3, which drops it the rate to 4.4%. There's a base effect in there, and maybe some rounding on a three-digit number because the expectation was for 4.3, but it does show continued progress. Average weekly hours, 34.7. That's a major jump for that category from 34.3. Labor force participation rate, 62.4%. It was 62.3%. So we've had some major gains here on the employment side. And I guess we'll have to wait just a minute to get to Neil Dutta because he's running around his room, opening champagne and jumping up and down. But this is a shockingly good report because we see a big gain in jobs without a big gain in earnings. And that's going to matter to the Fed.
Neil said there was upside risk. I'm not sure he meant that much. 517,000
anybody did
in the jobs report. Unemployment 3.4%. Wages a little higher than anticipated year over year, in line month over month. But wow, what a move. And look at the move in the market. Equity futures down on the S&P by 1% on the S&P 500. The moves in the bond market, you can guess the moves in the bond market. Yields higher by 9 or 10 basis points right the way through the front of the curve. The 2-year up by 10 basis points to about 420 now. On a 10-year yield, we are higher by 7 or 8 basis points to 347. Elsewhere in the FX market, I think you can take a guess as well. Euro dollar negative, a break of 109. Tom, 108.71, down a third of 1%. That is what we call, TK, a blowout jobs report.
Off the headline numbers, I take that statistic, 517,000. I add the 1 month revision. There's 2 month revisions as well. And it's a small number of 554,000. Mike, I'm going to go to you before Neil Dutta. And my basic idea is I know you've never seen this before, but is the shock of these numbers because of pandemic dynamics and the end of the year moving around? Or is the shock of these numbers, is it 98.285% of us got this wrong?
Well, I think probably the latter, in the sense that we don't know exactly why we all got this wrong and why the number is so much bigger than anticipated. Because we're talking the establishment survey. We knew that the household survey would be disrupted in terms of employment because of the changes to the population control numbers. But the establishment survey isn't affected by that, and this is really a blowout. There's obviously probably some seasonal effects in there, probably some effects from the pandemic lingering in terms of the seasonal adjustments that BLS makes, but this just seems to suggest that American companies are not at this point feeling the need to cut back. Leisure and hospitality seems to be the big gainer, and we know that there have been a lot of openings there and that restaurants have been desperate to try to find people, so it looks like they are getting some people coming off the sidelines.
To try to understand the narrative behind this, Ellen Zentner was saying that perhaps wages are coming down more quickly than people had previously expected because there isn't as much churn in the labor market, the job switchers that push wages and wage gains higher. How much is that sort of masking the underlying strength that is going to be in wages for longer, even if we're not seeing it in the same kind of degree with headline numbers like this?
Well, it's hard to know how long it'll be in there because it'll depend on the composition of the labor force and who's getting the jobs. Obviously, people who are in tech moving from one job to another are probably making more money. And we've heard anecdotal reports that the people who are getting laid off are getting picked up quickly. Does it mean that restaurants are paying more? I'll have to take a look at the numbers in terms of average hourly earnings, but it suggests that we're getting to the point now where companies may not have to offer that kind of thing. The only point I would make is that Tom Brady is a job switcher, not a he didn't retire to switch jobs for a lot more money. So Lisa's point holds.
His wages skew the number. Let's be clear.
I was going to say he moves GDP.
Mike McKee, thank you. That is a monster upside surprise. 517,000. The only big economist on Wall Street that came anywhere near was Citi and Andrew Hollenhorst, a little north of 300k. Neil Dutta looked for an upside surprise. Well, here it is. This is what Citi said earlier this week. Powell's hopefulness must now confront the data. The dovish market reaction to Chairman Powell's relatively neutral comments implicitly assumes inflation will continue to cool faster than the Fed expects, even absent a further tightening of financial conditions. Tom, here's a question for you. If Chairman Powell had this report in hand on Wednesday, in the news conference, would the press conference had been any different?
Would have been different. Yeah, I think so. I think that what I see here, John, that's so important, with immense respect to how Mike McKee owns this story, is you wonder, does the rest of the world begin to trust the data if so many people are getting this wrong?
Have we got the perfect guess for this?
This goes back to Jack Welch and his criticisms of Washington economic data, the late, great Jack Welch. And you just wonder, do you trust the data? Why don't you bring in the optimist?
Neil Dutta, the head of US economic research at Renaissance Macro. Neil, are you seated or are you running around the room?
I just got back to my seat. Look, Tom, I trust a lot, just going to Tom's point, I think for your audience, it's not about trusting the data. It's about trusting the people interpreting the data, just in the same way political polls, right? I mean, the polls are off. No, the polls aren't really off. What's off is the people's interpretation of those polls. And that's what's going on here. I mean, keep an eye on part-time employment, part-time employed for economic reasons. Anyone who talks about that, it's a tell because it went up.
Neil, just because of time, I want to go on this. I think it's absolutely historic here. I'm gonna fold it, and there's other names as well, folks. Neil Dutta, along with the great Jim Glassman at J.P. Morgan, with his decades of study of the labor economy. He owned the study of teenage employment years ago. And John just mentions Neil Hollenhorst over at Citigroup, who came within the vicinity here. What are we getting wrong about the fabric of American labor when it's staring us in the face with large parts of America with 2 and 3.0% unemployment? Why are we getting this so wrong?
Well, I think it starts with, the underlying economic momentum in the country, which is picking up. I mean, it could well be that, conditions are picking up. Employers had positioned for an alternative outcome for things to be slowing down. Now they find themselves having to play catch up to that stronger economic growth. I mean, look, the underlying rate of employment is not 520,000. I mean, that is true, but it's probably higher than where the consensus believes. And, given what we know about the trajectory going forward, there's risk that employment will remain strong. I mean, if you're talking about 200,000, let's say it's half the rate. Let's say that's the real number, half the rate of what we got today. So it's 250,000. That's more than enough to continue pushing the unemployment rate down over time. And so, look, I mean, I've said this, the onus is on the economic bears. Frankly, I don't think this is going to really change the Fed's calculus. I mean, guys, it's not like they're going to come out and say, "Oh, we got to go back to 50." All they can do at this point is just sort of extend out the 25s.
But Neil, how much are we looking at people who are getting multiple jobs because they're trying to deal with inflation? How are we looking at one person accounting for 3 of these jobs that have been created?
I mean, I have to look at the multiple job holders as a share of employment. That's in the household data. I haven't looked at that yet, but it doesn't look to be abnormal. And look, I mean, if you don't believe the BLS, what about consumers? Look at what consumers are telling you about the jobs market, okay? The labor differential from the Conference Board, also a January data point, that was out earlier this week. I believe it rose to a 3-month high. And it's at a very, very strong level, certainly, more or less where it was before the pandemic, if not a little higher. Again, consumers are telling you that things are okay in the labor market. And consumers, and this is drawing on research from the New York Fed, consumers have a habit of spotting changes in their own local economies before the data because they know the places that are, putting up help wanted signs. They know the places that are handing out pink slips, and they see it before the survey collectors of the BLS do. And so, consumers are telling you that the labor markets are fine. And that unemployment is low. So if you don't want to take the BLS's word for it, maybe we can just take the American consumer's word for it.
Neil, get on the phone and tell some people I told you so. Neil Dutta there of Renaissance Macro. Fantastic to catch up with Neil. TK, he told us there's your upside surprise.
There's the upside surprise. And as you go into your hour, John, I go into radio, I really want to emphasize it with the equity. I thought the equity market pullback here would be bigger. The NASDAQ futures down 1.6%.
Sure.
Are, John, still sitting above the 2 standard deviation trend of the January explosion. I thought we'd pull back more given these stunning numbers. No, we have not.
Do you take comfort from the fact that wages didn't accelerate in the way that maybe you might have guessed if payrolls came in at 5.17 and unemployment dropped to 3.4%?
I'm not going to give my opinion on this. Nobody cares. But the answer is it is an inflation dynamic and a growth dynamic. And the Dutta optimist, the Glassman optimist, maybe Hollenhorst is going to join that group. I don't want to speak for him or Steve Whiting yet.
Sure.
But the bottom line is, do we have a growth misestimation that you mix into March and April?
I wonder how different that news conference would have been with Chairman Powell. Coming up in the next hour, looking forward to this, Mohammed Al-Aaron of Queen's College, Cambridge, Rick Reeder of BlackRock, Anastasia Amoroso of iCapital, Mike Collins of PGIM Fixed Income, and at 9:30 Eastern Time, we'll catch up with Secretary Marty Walsh, which I imagine he's going to have a little bit of a spring in his step, Tom, at the start of that conversation.
This is a social statement here, and Mike nailed it absolutely. The consensus has a view, and as Dutta said, they have not gotten this right for whatever reason. I mean, there's no other way to put it. Let's do this. We're going to keep driving. Do you have one insight quickly? Mike McKee, one insight here before Jeff Rosenberg.
Big change in service industry jobs. The service industry jobs leading the way with 378,000 jobs for the month. So we're seeing the jobs created or picked up in the area that people are looking for. And also the wage numbers were revised for December to up to an 0.4% and 4.6%. So the drop in the average hourly earnings is even greater than just what appears off the surface.
We'll save it for another conversation. And productivity and unit labor costs may be suggesting a better growth picture for the American economy. Jeffrey Rosenberg joins us right now. He's portfolio manager, systematic multi-strategy at BlackRock. Jeff Rosenberg, does this adjust a fixed income view of BlackRock?
Yeah, you have to understand this is a big pushback to the slowing, and it's a reminder of what Powell tried to say to the market, though the market wasn't listening, that their main concern is they're not yet seeing the impact of their tightening in the labor markets. And so this is a very clear message and a really kind of important warning that perhaps the interest rate sensitivity, put housing to the side, put the interest rate sensitivity of the economy to the Fed's tightening to date. Yes, there are long and variable lags, but we haven't really seen that degree of tightening. And when you take the financial conditions easing, the combined is perhaps what we're seeing here is the inability of the Fed to really get to its goal, which is to rein in the inflation pressures from a market. Powell said it again on Wednesday. It's still a labor market that is too hot.
Given that we are not seeing wages, Jeff, increase to the degree that some people might expect with such a headline blowout number, do you take comfort from that, or do you disregard that as a compositional effect of what jobs are getting created right now?
Yeah, the AHE number in terms of giving us a read on wage inflation is probably the most distorted because of the mix shift. Earlier this week, we got ECI, you've got ADP, and you've got probably the best measure, the Atlanta Fed wage tracker. At least those latter two are still pointing to an elevated level of wage inflation that I think is still very concerning to the Fed. And again, Powell was explicit when he said that earlier this week. The market wasn't listening. This report is a reminder that the tight labor market is still going to be an issue for the inflation outlook and for the Fed outlook.
How would you play this then, Jeff? If you really trust the headline number more than you trust the wage number, why would you buy 10-year treasuries where they are if you believe that this Fed could be that far behind the curve maybe later in the year before it's apparent?
Well, it's a good question, Lisa, and you asked about 10-year treasuries, and I think you have to be a bit cautious here on the degree to which we've seen the rally in back-end yields, and you don't have to buy those yields here. You can buy the shorter end of the market. The curve is at a historic level of inversion, and I think there's more vulnerability as a result of that. And from today's report and what we're seeing, not just from today, but for a long time in the data, the degree of tightness in the labor market may really challenge the ability of the Fed to deliver that pivot that the bond market's pricing in for the second half of the year.
Jeff, it's a little bit off your remit, but I'm going to go there because I know Alan Meltzer and Marvin Goodfriend beat it into you at Carnegie Mellon. And that is, I wanted you to link in here the shock of 517,000 and the 48 other numbers that indicate this job boom that some few have called for, and the Biden stimulus. It just seems, are we underestimating, Jeff, tranche one? Maybe this is for Glenn Hubbard's coming up as well. Are we underestimating, Jeff Rosenberg, tranche one, tranche two, and tranche three, which can be summed up, as Blanchard says, of the Biden stimulus? Is that what we're getting wrong?
Well, what we're getting wrong and where the confusion is at is a tremendous distortion in the economy from COVID, both the COVID impact and the COVID stimulus. And so we're seeing the backside of that. And really what you take out of today's report is really the strength in services. And this is the handoff from the goods economy to the services economy. But we're also seeing those distortions in our read of inflation. The deflation that we're seeing from the goods side is pushing down the headline and the core measures of inflation. It's making it look like we've made a lot better progress. Again, Powell talked about this on Wednesday when he pushed back against the market inflation forecast to highlight that we shouldn't expect that goods deflation to persist, and you're going to start to see some of that come out. So this confusion from COVID and the fiscal stimulus is part of that, is also what we're seeing in the makeup. The surprise numbers that Mike McKee highlighted is all from the services side of the economy, highlighting the transition and the strength that we continue to see there.
Jeff Rosenberg, thank you so much. Particularly thank you through this historic week. Mike McKee, he's looking at me like, before we get to Dr. Hubbard, you've got one nugget. What is it?
This is really interesting. We have a massive seasonal adjustment factor for the month of January this year. And on a non-seasonally adjusted basis, the economy lost 2,505,000 jobs. Last year, 2,420,000 in the month of January, but it was revised seasonally adjusted to 364. This year, 517. So an additional 200,000 jobs, basically, from seasonal adjustment numbers in this. And as we thought, this may be a hangover from the COVID pandemic years.
And I think it speaks to the unusual time of it. Lisa?
I just want to point out Alan Ruskin of Deutsche Bank just sending out that he thinks this data is far more befitting of the Fed view than the market. And that, to me, is really interesting. Right. Basically talking about how this is really confirming what they see.
My whipsaw on it, we got S&P futures down -50, but the 2-year yield shows you the whipsaw. Were we considering 3.99 down to 4.08? We back up essentially 18 basis points from that, now 14 basis points higher on the 2-year, 4.24%, showing the adjustments. It is a perfect guest at the perfect time. He was so much involved with the rebuilding of Columbia Business School. As we spoke to Abby Joseph Cohen of Columbia Business School the other day, he is Glenn Hubbard, director of Columbia's Chazen Institute for Global Business, and steeped in the underestimation that we have of the American economic experiment. Glenn Hubbard, I want you to speak of the microcosm, the initiative, the way we go out on a micro basis and find growth in America that pushes against traditional caution, traditional gloom. You've owned the high ground on that for decades. Are we underestimating the American business spirit?
Well, I think we are, Tom. And importantly, as was said before, we're underestimating how hard it is to forecast in the recovery from COVID as we change in the mix of consuming goods and services, how firms adjust, how industries adjust. I thought we would see an upside surprise, nothing like this, I confess. But it tells me the jobs market is much more robust than markets had thought. and certainly a worry for the Federal Reserve.
I look, Glenn, at the fiscal stimulus of this, and let's go to your public service for the nation, typically with those of the Republican persuasion. Olivier Blanchard, who you and I will agree knows the math, Olivier Blanchard calls this the Biden stimulus. Are we still witnessing stimulus effect that leads to these shock numbers?
I think we're witnessing two things. One is the hangover from excessive aggregate demand stimulus, so I agree with that. But we're also seeing a lot of adjustment as the economy comes out of the COVID pandemic, the goods boom, and now our recovery in services, which are very labor intensive. So I think when people forecast jobs, they have to do so at a more micro level, given both of those factors. And I think the job market's likely to remain hot, posing a real challenge for the Fed. Remember, the JOLTS data were pointing in the same direction.
I'm just thinking about what Alan Ruskin over at Deutsche Bank said in response to this jobs number, saying, more broadly, one has to think in terms of higher equilibrium rates in this cycle, given very unique labor market resilience and therefore less expenditure sensitivity to rates. Glenn, how high do neutral rates have to go if this labor market is as strong as it seems?
Well, keep in mind, while the Fed has adjusted, one could hardly describe monetary policy as overly restrictive, given where inflation is. So I think there are two challenges for the Fed. One is figuring out how high, and I agree the Fed's not likely to revert to very large rate increases, so more gradual rate increases, but probably into the fives. But it may have to hold it for longer than market participants think. The Fed, of course, has been signaling that, but the market doesn't believe it.
Do you think that this kind of strong data makes the idea of a soft landing more likely or less likely because of how long the Fed will have to hold rates high?
I'm going to give you the classic economist answer, both. It could make it more likely in the sense that we obviously have a very robust underlying economy, giving the Fed some room to move. On the other hand, the possibility of a policy error here is quite significant. So I think this is a tough going moment for the Fed. It's not easy for the Fed. And markets, by occasionally loosening financial conditions, make it even more challenging for the Fed.
Glenn, I look at the path forward here. And I think one of the surprises underreported in the 3 tumultuous days we've had is productivity lifted. Unit labor costs came down. Are you an optimist that out of this horrific pandemic, all the shocks, all the once-in-a-lifetime events we've had, that we can find a new productivity?
Well, let me start longer terms. That's always safer for economists. I am an optimist about productivity growth future in the U.S., given technological advance and how it's penetrating through. I'm also optimistic that the recovery from COVID is leading to some reallocations that may raise productivity. That said, of course, we've seen a lot of productivity fluctuations, positive and negative, in recent years, and one swallow doesn't a spring make.
Glenn, we're talking a lot about trying to understand a very uncertain economic moment as the world recovers from a pandemic. There's a larger question that the Fed has to deal with as well, which is what is the implication of looser financial conditions and getting them further away from their goal of an ongoing disinflation? We've heard from a number of wonderful economists this morning saying it doesn't really matter at this point because of all the tightening from last year. Do you agree?
Well, again, I'm going to have to equivocate in standard econ way. Milton Friedman taught us years ago about long and variable lags of monetary policy. So there's reason to be cautious, as that view suggests. That said, there's a lot of momentum in the economy, and the way to tighten financial conditions is to tighten financial conditions. And so I think the Fed still has more work to do than the markets think.
Do you still think that this Federal Reserve should go above 5% and decidedly so?
I do think so. And thought so before this report.
Glenn, one final question here. We've got just a stream of news this morning. And I just want you to talk to me about the return of the risk-free rate. You got the chalk in your hand like Professor Joseph Cohen up at Columbia Business School, and you got a lot of bright young people that have never known actual cost of money. What do you tell them about this new world that's the old world you and I and Abby used to know?
Well, I think it's a matter of reminding people of basic discounted cash flow math that's whipsawing technology prices, stock prices, whipsawing prices of other goods producing sectors as well. And then also that higher returns for savers can be a good thing on the other side. So I think we're learning that risk-free rates in equilibrium aren't zero. in an economy that's growing.
Very good. Glenn Hubbard, thank you so much. We're going to go to Ira Juria. Glenn Hubbard with Columbia, and of course, okay, fine. Thank you for that, Matt. We've got huge news streaming, and we're going to talk about this with our balloon expert, Lisa Abramowicz, joining us now from Balloon Central. These are stunning headlines, and they sort of allude, Lisa, to the mystery we're talking about. China says balloon is for civil use, climate research. Pick it up from there. Regretful.
So, from the Chinese foreign minister, they released a statement after we spoke all morning, and a lot of people were talking about that balloon over the skies in Montana that was a surveillance balloon. That was the accusation from the United States. China responding and saying it was regretful that the airship entered U.S. air due to a force majeure, saying that it was for civil use, as you said, in climate research. Again, how does this dovetail into Tony Blinken's expected trip there? He was expected to arrive on Monday. They have yet to make a decision about whether he will go. Just to understand this swirling drama, it really highlights the tense moment of just not making this relationship worse, let alone making it better.
I think it's an opportunity, and if we know what they know and they know what we know, they know that we know, et cetera. Did you get all that? And the answer is this maybe comedy or mistake or force majeure, which is, I'm going to say, is a legal phrase and unusual. Maybe it's an opportunity for not celebration, but conviviality and a point of dialogue to restart a relationship that many would say is fractured. Is it an opportunity at the end of the day?
What, the balloon?
The balloon. Is it an opportunity?
I don't think it's a balloon opportunity. I think that this was either way. Perhaps it was a trial balloon, as we heard from Anne-Marie, to sort of test what the U.S. response would be. Perhaps it was just a mistake. Perhaps it was actual surveillance. Either way, it just highlights the fraught nature that suddenly this is the top news, is a balloon over the skies of Montana, potentially from China, because they're already potentially surveilling different things. This is about just further incursion into U.S. territory.
Stephen Engel will have a lot of coverage led by with our Asia team, Enda Curran and all. Vivian Mann, of course, with her leadership out of Hong Kong, radio and television there on the China trip of the Secretary of State. We've got a little more time. You got to the way this works, folks. If we can get a wide shot here, McKee sits next to me, and he has triple top secret stuff. And the reason they put him next to me is Bramo's got Ted Williams' 2010 eyesight, and McKee knows I'm blind as a bat, so he's got state secrets here, and I can never see him. What do you see?
I don't have any top secret documents at home. Please tell the special prosecutor. I'll give you one more interesting thing here. The labor force went up by 886,000, and that is adjusting for the changes on a monthly basis by the BLS this month. So massive number of people's coming into the labor force, which tells you something about why jobless claims are so low.
Hold on a second. This is really important. Is this confirmation of what people were hoping, who are all called overly optimistic, that you would see basically all the people who were on the sidelines after the pandemic flood back to the labor market in the face of higher inflation, basically reducing unemployment further, but allowing wages to not rise that much? I mean, is this basically confirmation of that?
Could be. It's kind of hard to tell because at this point, it's not a month you would expect that to happen. I mean, historically, people get let go in January who were temporary workers, and the weather is lousy. Mm-hmm. And you would think that maybe in the summertime when kids get out of school and go to looking for part-time jobs. So to have that kind of number in January is usually the thing you would get if there was a rebound, like if nobody could work in December because it was too cold. You're going to be around today? You're not exiting. You're not leaving right now, are you? They're not going to let me. I think. It's just amazing. Michael McKee, thank you so much. World-class effort there. And
thank you.
Really, thanks to Lisa. Should we say thank you to our team? We never speak to them.
Our team is fantastic.
The guest quality today, the range of this debate is something we'll fold into next week. And yes, on to Valentine's Day in the inflation report. Futures at -51. I'm going to call it a resilient stock market after what we've seen. Thank you for joining us. Bloomberg Surveillance.